In this presentation, we will be discussing the Earned Income Credit, EIC credit. This will be a long presentation. If you would like to go to relevant topics, relevant information, jump to a specific point within the presentation, go down to the description below and you'll find links and description of key points, key places, key topics within the presentation that can take you directly there. You'll also find other information including the publication 596 and instructions for the Form 1040, where much of this information is generated from. In this presentation, we will be discussing the Earned Income Credit, often abbreviated as the EIC credit. We'll be discussing what the Earned Income Credit is and an overview of it. We'll be referring to publication 596, 2018. So first of all, what is the Earned Income Credit, EIC credit? To the text, the Earned Income Credit, EIC, is a tax credit for certain people who work and have earned income under $54,884. Obviously, that's a very specific number, but that's one of the complications with the Earned Income Credit, is to determine what that number is, and to determine the credit is a little bit complex to go through, so we'll go through those processes in future presentations. Back to the text. A tax credit usually means more money in your pocket. It reduces the amount of tax you owe. The EIC, or Earned Income Credit, may also give you a refund. So what it's saying here is it's going to give you a refund, and that term's a little misleading when we talk about the Earned Income Credit, because really a refund would indicate that we paid taxes and we're getting money back from the taxes that we paid, meaning we in essence are paying less taxes than we actually paid in, because we're going to get a refund of some of the taxes that we paid. However, that may not be the case with the Earned Income Credit. In other words, we may get a refund or money back even though we haven't paid any taxes. And this is really important to know, because if you are in a situation where you didn't pay any taxes, you know you didn't pay any taxes, you might say, well, I don't need to file a return, which would be a logical thing. Maybe you don't need to file a return, or in other words, it's not required by law to file a return. However, it might be beneficial to file a return because you might get a refund, which is really more like a payment, even though you haven't paid anything to the government from something like an Earned Income Credit or the Child Tax Credit. Therefore, it might be worth your while then to process the tax return, look into whether or not you qualify for the Earned Income Credit, because we're not really talking about a refund here. In some cases, it may be partially a refund of money that has been paid. So if you have any W-2 income or anything like that, they've probably withheld money and you could get that refunded. However, it also could be more than that. So you might be saying, I only paid a little bit out of my W-2 earnings. I didn't make that much money. It's not worth me paying for the taxes because the amount of the refund is going to be very small. And therefore, it's not worth filing taxes if I don't have any tax liability and am not required to do so. However, it could be worth it given the case that we have the Earned Income Credit and possibly the Child Tax Credit. So it might be worth looking into those, because you're not just going to get the money back that was taken out of your W-2 check. Possibly, it's possible to get a refund that's going to be greater than that amount, and that's what we want to basically consider and think about through here. It's a little bit complex, this Earned Income Credit too, so in order to figure that out, we got to go through some tables and see what that Earned Income Credit would be in particular types of situations. So can we claim the Earned Income Credit? To claim the Earned Income Credit, you must meet certain rules. These rules are summarized in Table 1. We'll talk about those rules in a future presentation, but first we just want to give an example to give an idea of what we're talking about with the Earned Income Credit. This is going to be our test tax return, or test 1040. We have a simple single individual here. We're going to say that they're head of household filing status rather than single head of household, one of the requirements generally being that we have a dependent. So we have this one dependent, and that dependent is also qualified for a child tax credit. So we have a child here on the return, single individual, in other words, not married, filing as head of household. In that case, we're going to say, all right, what if there's a condition where there wasn't much money earned? Only we're going to say $18,000 on the year. $18,000 was earned, W-2 wages. We're going to say that the total then is $18,000 for the adjusted gross income, no adjustments to it. And note that the standard deduction in 2018 for head of household is $18,000. So that means there's no tax liability. Nothing would be owed. And so, and it might be the case that this individual knew that going into it and told the employer, hey, don't take any money out of my W-2. I don't owe any taxes possibly. And therefore no taxes were paid. And so there's you might think, well, what's the point of filing the return if there's no taxes that were paid and therefore no refund that you'll get back, other than if you have to file the return for reporting purposes, which you may not do. But even if it's the case where you may not have to file the return for reporting purposes, it might be worth doing if you have some of these credits that could take you beyond the liability. In other words, you might get a refund, in quotes, which is more like money. It's not really a refund because we didn't pay any money in. We might get money back above and beyond. And one of those things is the earned income credit that could do that. So here's the child tax credit that's basically, that could be something that could do that. We'll talk about that in other presentations. That's not where we are focused here, but it's often something that will be there as well. Another type of credit that could take us below, and the liability being below, meaning we get money even though we haven't paid anything in. And here's the earned income credit. So we're calculating it here. We'll talk about the calculations for it, but you can see that it can be significant even if no money was paid in. So that we can have a significant amount of earned income credit even if no money was paid in. This is based on basically one of the factors here that is influencing it is the dependent and, of course, the income level. We'll have to talk about those characteristics, the income level, the number of dependents, the filing status. Gets a little bit complex to determine the amount of the earned income credit. But just note that it might be worth doing for many people, even when they first think about it and say, maybe it's not worth filing the tax return. In some cases, it might be worth filing the tax return because of something like the earned income credit. Here's another scenario just to see how this might play out with two dependents. We'll see more scenarios later, but if we had two dependents, we can see that the earned income credit will typically be affected. No change to the income, still $18,000, no tax was paid at all, and we have an increase just based on this information in the tax return right now to the $5,716. So it becomes significant. And again, it's going to be multiple factors that are going to affect that. We're not going to go into the actual factors at this point. We'll talk about that in future presentations, but just note at this point in time that it could be something significant and worth considering. In this presentation, we'll take a look at the Earned Income Credit, EIC credit, and look at the steps to see if we can take the Earned Income Credit. These can be found on the Form 1040 instructions, and we're just going to go through these fairly quickly and then think about these items in more detail by looking at the publication. So it's worth going to the 1040 instructions and go through basically this questionnaire as we'll do here. To take the Earned Income Credit, the EIC, follow the steps below. Complete the worksheet that applies to you or let the IRS figure the credit for you. Note that we're going to be looking at the worksheet. We'll go through a worksheet, but also note that it's useful to have tax software. So tax software can, of course, help by basically putting the appropriate worksheet into the tax software to help to do these calculations. But it's nice to see the manual calculations as well, just to see what the complexities are through the calculation, and we'll look at both of those methods. Back to the text, if you have a qualified child, complete the attached schedule for the EIC. So a qualified child, we'll discuss what the qualified child is and then how to apply that into our calculation of the earned income credit. Back to the text. Tip, the amount you enter on line 17 will be the total of your earned income credit plus any additional child tax credit and American Opportunity Credit plus any amount from Schedule 5. In other words, if we go to the tax return, here's the 1040. This is our mock 1040. And we're going to go down to line 17. They're talking about line 17 is where we have these credits that we're talking about. Here's basically a child tax credit. Here's an earned income credit just from this mock example. And that's going to give us the amount on line 17. It's not the only place where the credits are, because we also have credits up top. And these credits up top are usually those that will bring liability down to zero. So line 17 are typically those credits which could actually give us a refund even if we haven't paid any liability or the liability is currently zero, meaning we're going to get a refund above and beyond any liability. We have no liability at that point and we're still getting money back, and that includes the earned income credit child tax credit. Back to the text. For help in determining if you are eligible for the earned income credit, go to the IRS website here and click the EITC assistance. This service is available for English and Spanish. So this is one area to go to the IRS website to question about the earned income credit. It is something that's a bit complex, especially if you're going to do it by hand. Nice to have software to help with it as well. Back to the text. If you can take the earned income credit, even though you aren't eligible and it determined that your error is due to reckless or intentional disregard for the earned income credit rules, you won't be allowed to take the credit for 2 years, even if you are otherwise eligible to do so. If you fraudulently take the earned income credit, you won't be allowed to take the credit for 10 years. See Form 8862, who must file later. You also may have to pay penalties. So note that the earned income credit, because it is significant, is a place that abuse can happen. And if you abuse the tax code, intentionally report the earned income credit, then of course there'll be tax consequences for that. And so just be careful with that. We'll discuss more of those consequences at a future presentation. But you want to avoid any of that, of course, and make sure that you're following the rules by going through all these steps of the earned income credit worksheet to make sure the claiming of the earned income credit is appropriate. Back to the text. Refunds for returns claiming the earned income credit can't be issued before mid-February 2019. This delay applies to the entire refund, not just the portion associated with the earned income credit. Next item, we're going to go through this process now. So here are the steps that we'll go through. So step 1, all filers. Number 1, if in 2018, 3 or more children lived with you, is the amount on Form 1040 line 7 less than 49,194 or 54,884 if married filing jointly. So what we're doing here is trying to see if we would qualify for the earned income credit in this, basically in this step 1. So if we think about that, we're saying, okay, we're looking at line 7 on the tax return. So line 7 on the tax return is what we call adjusted gross income. So the adjusted gross income you can think of basically as the income level. We're looking at income level to see if someone qualifies for the earned income credit. And we're looking at basically the caps. And one of the things that are going to affect the cap is the filing status, single versus married filing jointly, and the number of children. So here we have 3. If we have the second step then, or 2 children live with you, is the amount Form 1040 line 7 adjusted gross income less than 45,802 if single or anything other than married, or 51,492 if married filing jointly. So that's going to be the second step. Again, we got the income limitation and now 2 children. Then if we have 1 child lived with you, is the amount on line 1040 line 7 less than 40,320. Obviously, you'll note the AGI limit is going down for single or everything other than married, or 4610 if married filing jointly. So, and then finally, if no children, if we have no child, then lived with you, is the amount on Form 1040 line 7 less than 15,270. So if we have no children, then we have the 15,270 single filer. That's basically the lower limit, of course, on the earned income credit, 20,950 if married, no children. And then we would continue. And our goal is to see if it's worth basically filing or not, if there's potential to get the earned income credit here. This is basically the first step. If no, you can't take the credit. So if you don't qualify here, can't take the credit. If yes, we continue to the next step. Back to the text. Do you and your spouse, if filing a joint return, have a Social Security number issued on or before the due date of your 2018 return, including extensions that allows you to, and then of course, again, we're talking about the Social Security number. Do you qualify? Then we would typically need, of course, the Social Security number to do so. And then we'll go back to the text. Work and is valid for the earned income purposes. Explained later under definitions and special rules. We'll discuss that a little bit more in depth, but we need the Social Security. If yes, we move forward. If no, we can't claim the earned income credit. And again, of course, this worksheet is determining whether we can or cannot claim the earned income credit, and then we'll get into the calculation of it if it's determined that we can claim. Next item, back to the text. Is your filing status married filing separately? And note that if it is no, if it's yes, you can't take the credit. And what does that mean? It means that you can't file married filing separately. We'll talk about these more in depth, these rules. But basically, if you're married, you can have the choice of filing married filing jointly, or married filing separately. We're basically saying you can't file married filing separately. We'll discuss more maybe why later, but just note that. And so we're going to continue. And you can think of just basically tax scenarios where people would probably try to take advantage of this kind of credit if you can break up the marital status. But in any case, we're going to move on. We're going to go number 4, back to the text. Are you filing Form 2555 or 255EZ related to foreign income? If yes, can't take the credit. If no, we're going to continue. So there's an issue with foreign income here. So foreign income could disqualify the credit. So if we're reporting that, if we have foreign income on Form 2555, then you may have disqualifications. If that's not an issue, then we'll continue forward. Number 5, were you or your spouse a non-resident alien for any part of 2018? If yes, then we're going to see non-resident aliens later under definitions and special rules. If no, go to step 2. So we're going to continue on there, and then we got step 2. So investment income. So we're going to go to investment income, and there's going to be some limitations on investment income. So we'll go through step 1, back to the text, add the amounts from Form 1040, line 2A, 2B, and 3B, and then schedule 13. So 2A, 2B, 3B. Here is our 1040. So 2A would be tax exempt interest, and then we've got qualified dividends, and then taxable interest. Why are these investment income? Because they come from us having money, let's say in the bank or something, and generating investments or stocks and bonds. And the idea, of course, we'll talk more about this later, but the idea being that if you have a whole lot of money and you're making a lot and you're getting a lot of interest, then you have a lot of assets, and therefore the earned income credit, the goal of the earned income credit doesn't seem like it's applied there. So that investment income. So if you have a lot of investment interest and dividends, then that's going to be an issue. Next item, back to the text. 2, is your investment income more than $3,500? So again, that's that dividends and interest. If it's more than $3,500, it seems like you got a lot of assets and probably don't qualify for the earned income credit, right? So that's going to be the just. So if yes, then we're going to continue on and see some more qualifications. If no, we're going to skip question 3 and go to question 4. So in other words, if we have more than 3,500, we need some more questioning to see whether or not we'll qualify, and we'll go on to question 3. If no, then we're just going to skip question 3 and we'll go to question 4 and just move on with our qualifications. So question 3, which is the only thing we would only do if yes, are your filing Form 4797 related to sale of business property? If yes, see Form 4797 filers later under definitions and special rules. If no, you can't take the credit. So the general rule is if you have a lot of investment income, you can't really take the credit unless there's some kind of exception with relation to Form 4797. Otherwise, that's going to be the general rule. So now we'll go to question 4, which we would have done if we were under that 3,500, which says, do any of the following apply for 2018? You are filing a Schedule E. Schedule E has to do with rental income. So if you have rental property, again, that's another flag to the IRS saying, hey, you own rental property. That seems like you have a lot of assets, then possibly shouldn't be qualifying for the earned income credit. So then we got, you are reporting, back to the text here, you are reporting income from a rental or personal property not used in a trade or business. You are filing Form 8814 related to election to report child's interest and dividends on your return. You have income or loss from a passive activity. So again, these are areas where the IRS are kind of looking. Do you have passive income? Do you have income from rental property? If it does, it seems like your income, you have a lot of assets and therefore shouldn't qualify for the child tax credit. So if yes, use Worksheet 1, Publication 596. So then we have to go to the worksheet on Publication 596. We'll go to that publication later to see if you can take the credit. If no, go to Step 3. So we'll continue to Step 3 here. Qualifying child. A qualifying child for the earned income credit is a child who is your son, daughter, stepchild, foster child, brother, sister, stepbrother, stepsister, half-brother, half-sister, or descendant of any of them, for example, your grandchild, niece, or nephew. So qualifying child, remember, is one of those things that can affect whether or not we qualify for the credit and or how much the credit would be. Moving forward, we have and, so we're going to say and, was under age 19 at the end of 2018 and younger than you or your spouse if filing jointly, or under the age of 24 at the end of 2018, a student defined later, and younger than you or your spouse if filing jointly, or any age and permanently and totally disabled defined later. So next, we got the next item. We're going to say and who isn't filing a joint return for 2018 or is filing a joint return for 2018 only to claim a refund of withheld income tax or estimated tax paid. So in other words, the child, most likely we're kind of thinking here they're going to be on the form as our dependent, basically. If we're thinking about these kind of rules, we're saying, hey, this is someone that typically is going to be a dependent. We got the age limit to basically be the dependent typically, and those are kind of the general rules that we're going over here. And so in this case, obviously, if they're filing a joint return, they would be married and therefore probably wouldn't qualify as a dependent or a qualifying child for the purposes of the earned income credit. Moving forward, back to the text. Who lived with you in the United States for more than half of 2018. So we have that live-in requirements. Then we've got caution, back to the text. You can't take the credit for a child who didn't live with you for more than half the year, even if you paid most of the child's living expenses. The IRS may ask you for documents to show you lived with each qualified child. Documents you might want to keep for purposes include school and child care records and other records that show your child's address. So note that this is going to be an issue because, of course, if the IRS tries to prove this, it's difficult to prove that you paid for half of the child's care. What they try to do is, of course, prove the address. Is the address the same? So if whatever the school address is, where they send any kind of document related to the child, then they're going to basically want to see, are those documents going to your address at the same address? And that would be one of the ways that the IRS would verify this if in the case of an audit. Tip. If child didn't live with you for more than half 2018 because of temporary abuse, birth, death, or kidnapping, see exceptions to time lived with you later. So obviously there's a few obvious examples, and the two most obvious are going to be birth and death. I mean, if the child was born, halfway through the year, then of course they didn't live with you for the entire year, but still may qualify as a dependent. We'll talk a little bit more about that later. Caution. If the child meets the conditions to be a qualifying child of any other person other than your spouse, if filing a joint return for 2018, see qualifying child for more than one person later. If the child was married, see married child later. So it's another kind of issue that we have here. Obviously, if we have two people, say divorced individuals that have one child, then you got to be careful about claiming the child tax credit or the dependent itself on two different returns. You got to think about, well, how is that going to play out? So that's going to be a consideration we'll talk about later. Back to the text. Number 1. Are you claiming at least one child who meets the conditions to be your qualifying child and, unless the child was born and died in 2018, has a valid Social Security number, SSN, as defined later? If yes, we'll continue. If no, we're going to skip to question 2 and 3. So we'll continue on. Number 2, are you filing a joint return for 2018? In other words, you're married filing a joint return. Yes, skip question 3 and 4 and go to step 5. If no, we're going to continue forward. So they're kind of basically having a fork in the road here based on whether you're filing filing joint return or not. Question 3, which we would go to if we were going to continue on, meaning we're not filing a joint return. Number 3. Could you be a qualified child of another person for 2018? Check no if the other person isn't required to file and isn't filing a 2018 tax return or is filing a 2018 return only to claim a refund of withheld income tax or estimated tax paid. So in other words, if we can be reported by someone else as a qualifying child, and you could think of the requirements for that, they would have to have given more than half of our support and whatnot, then we're in danger, of course, of not being able to report somebody else on our return as a qualifying child. So if yes, we're going to say you can't take the credit, enter no in the space on to the left of line 17. If no, skip step 4, go to step 5. Back to the text, we're going to go to step 4, filers without a qualifying child. So now we're thinking about those filers that don't have a qualifying child. We're still saying, hey, do we qualify for an earned income credit, even though basically we don't have the qualifying child? And we know that one of the limiting factors there is going to be adjusted gross income limitation, meaning if we have over a certain amount of the adjusted gross income, it's likely that we won't be able to file under those conditions. Back to the text. One is the amount on line 1040, line 7, less than $15,270, $20,950 if married filing jointly. And you'd say, okay, well, what is line 7 on the tax return? So if we go to our mock tax return, we see that line 7 is going to be the adjusted gross income. So they're basically doing an income test here, and they're saying, hey, is it, I mean, do you qualify or not? Well, if your income is over that amount, then you may not qualify. So $15,270 adjusted gross income for single, $20,950 if married, filing jointly. If yes, then we continue. If no, you can't claim the credit. So if your income is greater than that adjusted gross income, can't claim. If yes, then we move on. Step 2, were you or your spouse, if filing a joint return, at least age 25 but under age 65 at the end of 2018. So now we have an age limitation here. So we've got the 25 to 65. Check yes if you or your spouse is filing a joint return, were born after December 31st, 1953 and before January 2nd, 1994. If your spouse died in 2018, or if you are preparing a return for someone who died in 2018, see publication 596 before you answer. So if yes, we're going to continue on, and if no, you can't take the credit. Continue on. Step 3. Was your main home and your spouse's, if filing a joint return in the United States for more than half of 2018? Members of the military stationed outside the United States, see members of the military later before you answer. So obviously, got to be within the United States as your principal residence, unless, of course, you have the military would be one obvious exception to that. If yes, we continue forward. If no, stop. You can't take the credit. Enter no in the place to the left of line 17. Number 4, are you filing a joint return in 2018? If yes, skip question 5 and 6. Go to step 5. If no, we're going to continue. So again, we got kind of a fork in the road here because there's going to be differences if we're filing a joint return versus a single return. Next item, 5. If you could you be qualifying child of another person for 2018? Check no if the other person isn't required to file and isn't filing a 2018 tax return, or is filing a 2018 return only. Again, if you can be qualified child from another return, if someone else can claim you as a qualified child, then you're in danger of course, not being able to report someone as a qualified child on your return, because it's unlikely you're going to pass all the tests, the support tests and whatnot, if you yourself are basically kind of could be claimed as a dependent somewhere else. That's kind of the logic of it. If yes, we're going to say you stop, you can't take the credit. If no, we're going to continue on forward. So we'll be continuing on. Number 6, can you be claimed as a dependent on someone else's 2018 tax return? To answer that, you'd basically need to know what a dependent is, the qualifications for the dependent. But in essence, there's going to be some tests, including the caretaking test, someone else providing the care for you and whatnot. So therefore, if is a similar kind of requirement, if yes, if you can be claimed as dependent, we're going to say stop, you can't take the credit. If no, go to step 5. So we're going to continue forward. Step 5, number 1. Are you filing Schedule SE, which is self-employment, because you were a member of the clergy? So this is going to be a very special kind of example, a member of the clergy, or you had church employee income of 108.28 or more. So if we had, basically, if we fall into that category where we were part of the clergy, part of the church, or have some kind of income for that required us to file the Schedule SE, self-employment. And so that would look something like this. Self-employment tax, then there's going to be some exceptions related to that. So if we say yes, see clergy and church employees, whichever applies. If no, complete the following worksheet. and then we would go through the worksheet, enter the amount from form 1040 line 1. So 1040 line 1, if we go to the 1040 in our mock 1040 and say, all right, here's 1040 line 1, that's basically our wages, salaries, tips, etc. And then we're going to say number 2, enter the amount included on 1040 line 1 that is a taxable scholarship or a fellowship grant not reported on form W-2. So if that applies, if part of the amount on line 1 is a taxable scholarship, then we would put that here. Number 3, enter any amount included on form 1040 line 1 that you received for work performed while an inmate in a penal institution. Enter PRI and the same amount on the dotted line next to form 1040 line 1. So there's going to be exceptions if you had income while basically being in prison or something like that, because again, they don't want to give an incentive or earned income credit to those individuals who are in violation of some kind of law or something like that, of course. So then we go to number 4, enter any amount included in form 1040 line 1 that you received as a pension or annuity from a non-qualified deferred compensation plan or a non-government section 457 plan. Enter DFC and the same amount on the dotted line next to form 1040 line 1. This amount may be shown in box 11 of form W-2. If you received such an amount in box 11 is blank, contact your employer for the amount received. So this is related to a deferred compensation plan. And again, you can look at your W-2 and it should be properly, hopefully reported properly in box 11. Number 5, enter any amount included in form 1040 line 1 that is a Medicaid waiver payment you exclude from income. See the instructions for Schedule 1, line 21. And again, you'll see your schedule and you can take a look at line 21 on the schedule. That's going to give us, we're going to add up then, add lines 2, 3, 4, and 5. So we're not adding the line 1. So in other words, we had line 1 was our income, and then we just removed these amounts that we could possibly remove, which may not be applicable to many people, which are on everything except line 1 of this worksheet. And that's going to be our item here. Subtract line 6, where we added all those items up from line 2 through 5, and subtract it from line 1, which of course was our item up top. So in essence, we're saying this is basically our wage, and if there's any of those other things that are affecting it, we're going to be subtracting them from it to get basically to line 7 here. Number 8, enter all of your non-taxable combat pay if you elect to include it in earned income. So if you have combat pay, then they're going to say here there's some type of election to include it. And so we'll get more into the publications on what that election might be. And why would you elect it? Because you might need more earned income. So they're saying it's not included in essence, you're thinking, well, maybe it's not included in line 1 here, but maybe we would want to include it for the calculation of the earned income credit because it might give us more of a credit. So we have that in possible. We'll talk more about that later. Also enter the NCP and the amount of your non-taxable combat pay in the space to the left of line 17 on form 1040. So that would only, of course, apply if we had combat pay. Back to the text. Electing to include non-taxable combat pay may increase or decrease your earned income credit. So note, we'll have to look at the tables to see if it would increase or decrease. If we have some area where we would say, hey, it would be nice to have more earned income because it would increase the credit because the earned income actually goes up as you increase to a certain degree, or we might be over that point and we would want less earned income because now the credit's going down. We're over kind of the hump of it increasing. And therefore, we would, if we had a choice, we would not want to include more earned income. So in any case, if this is an area where we have a choice to include it or not, it depends on how much earned income we have and how many dependents we have to see if we want to do it or not. Figure the credit with and without your non-taxable combat pay before making the election. So what you want to do, of course, then, if you have an option to include or not include, is figure the earned income credit before, then figure the earned income credit with the added income, and maybe some scenarios in between if you happen to be right in between there, and see what how to max out, the earned income credit. So number 9, add lines 7 and 8. This is your earned income. 2, Were you self-employed at any point in 2018, or are you filing Schedule SE because you were a member of the clergy, or you had church employee income, or you were filing Schedule C or CEZ as a statutory employee? So we're dealing with now the income for a sole proprietor, or Schedule E, self-employment income, dealing with typically business type income would typically be reported on the Schedule C. So Schedule C, business type income, that would then pull forward to the 1040 Schedule C or Schedule C EZ, net profit from business. So if yes, skip question 3 and step 6. Go to worksheet B. If no, we're going to continue forward. Number 3, if you have 3 or more qualified children, is your earned income less than $49,194? And we got these are our income limitations again. So, or $54,884 if married, filing jointly. For 3 dependents, if we had 2 qualified children, 2 qualified children, is your earned income less than this amount for single, or this amount if married, filing joint? If we had 1 qualified children, is your earned income less than this amount or this amount for married, filing joint? And finally, no qualified children, is your earned income less than that $15,270 or $20,950 if married, filing joint? So these are our income limitations again. So if our AGI is over these amounts, then we could say stop. We're going to have to not take it most likely. And then if we say yes, then we're going to go to step 6. So step 6, how to figure the credit. So now we're thinking, okay, if we qualify for the credit, then you got to go through the steps, then how to figure it. So all that was basically looking at qualification types. Now we'll go into basically the figuring, and we'll do some more scenarios on this in future presentations. Do you want the IRS to figure the credit for you? If yes, see credit figured by the IRS later. If no, go to worksheet A. We're going to basically concentrate on worksheet A. But if you want to talk to the IRS, maybe they can provide some help with calculating the worksheet as well. Then they do so under certain circumstances. Definitions and special rules. Adopted child. An adopted child is always treated as your own child. An adopted child includes a child lawfully placed with you for legal adoption. So if we have a legally placed adopted child, then of course they're treated just like your child for most tax preparation purposes. Church employees, determine how much of the amount on Form 1040 line 1 also was reported on Schedule SE, Section B, line 5A. Subtract that amount from the amount on line 1040 line 1 and enter the result in line 1 of the worksheet, step 5, instead of entering the actual amount from Form 1040 line 1. So this would be kind of a special exception if we had a church employee. Clergy, another kind of special exception. The following instructions apply to ministers, members, and religious orders who have not taken a vow of poverty, and Christian Science practitioners. If you are filing Schedule SE and the amount on line 2 of that schedule includes an amount that also was reported on Form 1040 line 1, do the following. Number 1, enter clergy in the space to the left of Form 1040 line 17. 2, determine how much the amount on line 1040 line the amount on Form 1040 line 1 also was reported on Schedule SE, Section A, line 2. And we're going to keep moving on. Number 3, subtract the amount from the amount on Form 1040 line 1 into the result on line 1 of the worksheet in step 5. Moving on. Number 4, be sure to answer yes to the question 2 in step 5. Okay, then we got the combat pay. So combat pay, another special kind of condition. Combat pay, non-taxable. If you were a member of the U.S. Armed Forces who served in a combat zone, certain pay is excluded from your income. See combat pay exclusion in Pub 3. You can elect to include this pay in your earned income when figuring the earned income credit. The amount of your non-taxable combat pay should be shown in box 12 of Forms W-2 with code Q. So if you have your W-2, look for that code Q. If you are filing a joint return and both you and your spouse received non-taxable combat pay, you can each make your own election. In other words, if one of you makes the election, the other also can make it, but doesn't have to. So we have a lot of flexibility then with the combat pay. So if that's a special condition, you want to look into that, probably run some scenarios to see how to maximize the earned income credit. If you elect to use your non-taxable combat pay in figuring your earned income credit, enter NCP and the amount in the space line 17. If that's going to be a condition that is special to you, you really want to kind of do some research on that, because of course that is a bit unusual, and you want to make sure that you're taking that into consideration if it is significant. So whenever you look into this kind of tax calculation, you really want to make sure whoever is helping you with that has awareness of that, so that you can make sure to do some scenarios with the combat pay and make sure that you're maximizing your credit. So here's going to be the worksheet. We're not going to go into the worksheet here. We're actually going to use software to enter this information in the software, and use kind of more of a trial and error scenario. So when we go forward, we'll always be bouncing back to the software, and then we'll go to the worksheet in the software. So these are basically, we've gone through the conditions to calculate or to qualify. We'll talk about those qualifying conditions more in future presentations as we go through the publications, and then we'll do scenarios to see how to do the calculation, and we'll do those in the tax software. And we'll have basically worksheets in the tax software, which will help us. And basically these worksheets come from the publication and or the Form 1040. And it's, of course, really nice to be able to use software to help you to go through those calculations and then verify those calculations based on the information on the Form 1040 instructions and the publication. In this presentation, we will be taking a look at the earned income credit, taking a look at the question of whether we can claim the earned income credit, this time looking at publication 596, more of a table format rather than a questionnaire format, more of a stepping out in a big picture type of format rather than a step-by-step process type format. Can I claim the EIC earned income credit? To claim the EIC earned income credit, you must meet certain rules. These rules are summarized in Table 1. So we're going to consider this table. We looked at this kind of in a questionnaire type format, but this is the overview, so we can get into kind of an overarching type of idea. So this first column, first you must meet all the rules in this column. These are going to be rules for everyone. So first column, rules for everyone. Your adjusted gross income, the AGI, and remember what that is on the tax return. The adjusted gross income is line 7 on the tax return, but you can think of it kind of just basically as a general income limitation that we have on it. So it's going to be 49,194 or 54,884 for married filing jointly. So we have different, of course, limits for married versus basically all other filing status. We can think of single or head of household being most typical. If you have 3 or more qualified children, so that's 3 or more children that are qualified children, and then the income levels. Well, okay, what if we had two qualified children? Then the income levels are 45,802 and 51,492, married filing joint, or all other filing status, single, head of household, most common. So, and then if we have the next item, if you have 1 qualifying child, we've got 40,320 or 4610, again, married filing joint, obviously the higher number, and the lower number for those that are not or single or head of household. And then finally, if you don't have a qualifying child, then we have the limits of the 20,950 and the 15,270. So you can see this table is a little bit more straightforward to just lay out the qualifications, and we can see them in all basically one step. And this is in the publication if you want to take a look at this. And then 2, you must have a valid Social Security number by the due date of your 2018 return, including the extension. So we have to have the Social Security number. That's how the IRS, we're a number to the IRS, and that's the Social Security number. Number 3, your filing status can't be married filing separately. So specifically, if you say married filing, and you can think about why that would be if you're having a joint return if you're married, and then you say, well, if I file separately, I can get this earned income credit. And the IRS is saying, no, you can't have a separate filing status just simply to take the earned income credit. And so they're just going to eliminate that by not allowing any filing separately to take that credit. Number 4, you must be a U.S. citizen or resident alien all year. So that we have the U.S. citizen or resident test. Number 5, you can't file Form 255 or Form 255EZ. And we'll talk more in depth about these rules as we go through the publication, but That's related to foreign income. So there's limitations related to foreign income if we had foreign income. Number 6, your investment income must be $3,500 or less. So if investment income, dividends, and interest being the most common two, if those are high, then the IRS would be thinking, well, you have a lot of assets and therefore you shouldn't really need this earned income credit possibly, and that could disqualify that as well. Number 7, you must have earned income. And that means that you have to have some earned income. You would think that the earned income credit, you would think that the credit itself is there for people that have low income, people that, need something, have lower income. But then, of course, there's some income limitation, and they want some income. So that's really kind of funny the way it works is that the credit could actually increase as income goes up, as you earn more, and then it's going to taper off at some point, and then of course you lose the credit at some point. So that's kind of a funny way the credit works, and that's why it's a little bit hard to think about and calculate because of that. But you can understand why to do that, because they want to incentivize income. So moving on. Second, you must meet all the rules in one of these columns, whichever applies. So here we go. This column, rules if you have a qualifying child. So now we're going to say, okay, what if I have a qualifying child? Now I have separate rules. These are the rules for everybody. Now we're going to say, here are the rules specific to that condition of a qualified child, as opposed to the rules over here if you do not have a qualifying child. So rules if we have a qualifying child. 8, your child must meet the relationship, age, residency, and joint return tests. We'll talk more about those, but just those would be what would need to be happening there for the qualifying child. Number 9, your qualifying child can't be used by more than one person to claim the EIC credit, earned income credit. In other words, if there's a divorced husband and wife or something like that, or some other condition where the child might be qualifying for more than one return, you can't claim the earned income credit with the same child in different returns, typically. Number 10, you can't be a qualifying child of another person. So if if we were a qualifying child of somebody else, then we can't really file for the earned income credit for our tax return, because we might be a qualifying child for someone else to qualify for their tax return. Okay, so we'll go to these rules. Rules if you do not have a qualifying child. So what if we don't have a qualifying child? Then these are the rules here. You must be at least age 25, but under 65. So we have this age limitation applied if we don't have the qualifying child. 12, you can't be the dependent of another person. So in this case, it's a dependency note test here. We can't be the dependent of somebody else and claim the earned income credit. And then number 13, you can't be a qualifying child of another person. So similar kind of restriction here. You can't be a qualified child of another person and claim the earned income credit. 14, you must have lived in the United States for more than half of the year. So we got to be living here for more than half the year. Again, these are just general rules within the table. There's more depth in the publications we'll talk about later. And then third, you must meet the rule in this column, figure 4, figuring and claiming your earned income credit. The earned income credit earned income must be less than. Now this looks a lot like the step 1 here, but notice it's a little bit different because this is your adjusted gross income, AGI, and this is your earned income. They might be the same because note on line 1, and these are going to be basically income areas. And line 1 is usually where a lot of your earned income might be because it's wages and salaries and whatnot. But so in this case, you could be taking the earned income, and there might be some things that could adjust basically the earned income, as opposed to the adjusted gross income, which are generally adjusted by the items that are on Schedule 1. So typically you have income here, and then the adjusted gross incomes are these items that might actually decrease it, kind of like deductions, adjustments to income, deductions above the line deductions that could adjust the AGI. So in any case, you got the same kind of limitations, 49,194 and 54,884 for married filing jointly. If you have 3 qualifying children, same over here, except now we're not talking about the AGI, but the earned income. 54,802 or 51,492 for married filing jointly. If you have 2 children, 40,330, 320 or 46,10 for married filing jointly if you have 1 qualifying child, and finally 15,270 or 20,950 for married filing jointly if you don't have a qualifying child. Next item, back to the text. Do I need this publication? So there's certain times when there's two main areas we're looking at to see if we qualify, and we have the publication here, and we got the instructions for the 1040. There are some specific areas where you'd need to go to the publication, and sometimes you could just go to the 1040. The 1040 is more of a straight line-by-line instruction type thing, questionnaire, and the publication will typically give more detail, and it'll give some more detail in those circumstances where there are a bit more complex circumstances. So it's often useful to go to the publication for the explanation, the details, such as this chart, but you have to go to the publication in certain cases when basically the questionnaire and the worksheet on the 1040 aren't enough. So certain people who file Form 1040 must use Worksheet 1 in this publication instead of Step 2 in their Form 1040 instructions when they are checking whether they can take the Earned Income Credit. You are one of those people if any of the following statements are true for 2018. So these are the conditions that would be true that would mean that you have to use basically the publication information here. You are filing a Schedule E. That's going to be dealing with typically rental income or some kind of passive income typically. Next item, you are reporting income from rental or personal property not used in a trade or business. So you got that rental property again. Next item, you are reporting income on Schedule 1, Form 1040, line 21, from Form 8814 related to election to report child's interest and dividends. And you have income or loss from passive activity. So passive activity rules could apply to rental property and other type of income where you basically have passive income rules. So if those items apply, then you'd have to come here. You are reporting an amount on Schedule 1, Form 1040, line 13, that includes an amount from Form 4797. So we'll talk a little bit more about some of these items as we go through some of the publications. These are going to be, of course, more unusual items for individuals who would be looking to file for an Earned Income Credit. Back to the text. If none of the statements above apply to you, your tax form instructions may have all the information you need to find out if you can claim the Earned Income Credit and figure your Earned Income Credit. So in other words, if those specific conditions don't apply, you may just be able to go to the 1040 instructions that relate to the Earned Income Credit and go through that questionnaire, and that might be enough. You might want more detail in this publication, but it might be enough just to calculate with the Form 1040. If those conditions do apply, then you would typically have to come to this publication and get that information related to those special circumstances. You may not need this publication, but you can read it to find out whether you can take the Earned Income Credit and learn more about the Earned Income Credit. So this is going to give us more detail about the Earned Income Credit rather than just basically a questionnaire type format. In this presentation, we will discuss help options from the Internal Revenue Service related to the Earned Income Credit, the EIC credit. This is from publication 596. Is there help options? The answer from publication 596, yes. You can use the EITC assistant so if you want to go to the IRS website, you're going to go to irs.gov/EITC to find out if you may be eligible for the credit. The EITC assistant is available in English and in Spanish. So if you want to help going through kind of these questionnaire type items, there are some resources online. So it's useful to think about these publications, the rules, and then go through the resources online. And there are some resources that the IRS gives to help with the calculations of the Earned Income Credit and know whether or not we qualify, which is basically, of course, the steps we have to go through. Do we qualify for it? Number one. If we do qualify, then we got to calculate it. Number two, and figure that process out. In this presentation, we will take a look at what is new related to the Earned Income Credit for 2018. This from publication 596. The first thing to note is that the Form 1040 is redesigned. So when you go to anything on the Form 1040, it's going to look a bit different. So as we've seen with the 1040, here is an example of the mock 1040. And just the look and feel of it itself is going to be a bit different from a lot different. It'll be a lot different in terms of how it will be formatted and how to enter the information into the system from prior years. Next item, back to the text. Forms 1040A and 1040EZ no longer available. So we know if you had a 1040A, which you may have done if you were filing for an earned income credit, we might have had a 1040A or a 1040EZ, which are more simplified returns, more simplified formats. What's been done now is that we have the form 1040 is basically the simplified format, and instead of having a completely different form and having to know when you would need a different form, they basically made these schedules. So they added information for the complex 1040 or the more complex 1040 form as opposed to the 1040A or 1040EZ, the less complex forms. Those complexities have all been taken out of the form 1040 and put into these added schedules. So now we only need the 1040 if it's a simple form, and if we need some of those added items, then we go basically to the schedules for it. Back to the text. So Form 1040A, 1040EZ aren't available to file for 2018. If you used one of these forms in the past, you will now use 1040. So it's actually easier in that regard. You're not going to have to think about, well, do I need a 1040 or a 1040A or a 1040EZ? The 1040 is the basic form. So that's actually should be nice going forward, but is a change and something that might take some getting used to. Next item, back to the text. Earned income amount. The maximum amount of the income you can earn and still get the credit has increased. You may be able to take the credit if, and then we'll go through the income amount. So note that just means that from year to year, this is typically the case. The general rule of many things will be much the same, but they will oftentimes increase the amounts to at least go with the amount of inflation or cost of living increases. So we've seen these before, so I'll go through these quickly. You have 3 or more qualified children and you earn less than $49,194 or $54,884 if married. So these are the limitations, the caps basically to be able to take the credit. So if you earn less than these amounts, married and or single or other than married, single, head of household and so on, those are the income limitations. You have 2 qualified children. So if you have 2 qualified children and you earn less than $45,802 or $51,492 if married. So here's the married number. Here's basically everything if not married. Next item, you have 1 qualified child. So if we have the 1 child and you earn less than $40,320 or $46,10 if married. And then we have, if you don't have a qualified child and you earn less than $15,270 for single, or $20,950. Those will be our basically income limitations to be able to take the credit. Your adjusted gross income also must be less than the amount just listed that applies to you. For details, see rules 1 through 15. So note, when we think about those income levels, we'll often hear basically the earned income, which often we can think about basically line 1 or adjust from there, and the adjusted gross income, which is basically down here on line 7, which could be decreased by the above the line deductions. And these are on schedule 1, the adjustments to income, the above the line type of deductions. So we'll talk more about those in examples. Back to the text. Investment income amount. The maximum amount of investment income you can have and still get the credit is $3,500. So now the investment income amount, interest, dividends, and whatnot, is at that $3,500. In this presentation, we will take a look at the 7 rules that everybody would have to meet in order to take the earned income credit. We saw these rules in a prior presentation in the table. We're going to list these rules again, and then we'll go into more depth about those rules in future presentations. This is from publication 596. So rules for everybody related to the earned income credit. Back to the text. This chapter discusses rules 1 through 7. You must meet all 7 rules to qualify for the earned income credit. So these are rules that you have to meet, and we'll get into more detail about that. We'll overview the rules here, and then we'll go into detail about each one of them, given to the specifics of each one of them. If you don't meet all 7 rules, you can't get the credit, and you don't need to read the rest of the publications. We need all 7 of these items. If you meet all 7 rules in this chapter, then read either chapter 2 or chapter 3, whichever applies for more rules you must meet. So these are the rules for everybody, note. And then we had to remember those rules that are going to differ between if we have a qualified child or not and whatnot. So then we have some forks in the road. So these are going to be the rules for everybody, and then some forks in the road for more rules after that to see if we meet this. So rules for everybody. Rule 1, adjusted gross income limitations. So we've discussed those a bit already. We'll go into some depth on those. Rule 2, you must have a valid Social Security number, SSN number. Rule 3, your filing status cannot be married filing separately. Just can't have it. Can't have a married filing separately. So remember, if you're married, then you only have two options: married filing joint or married filing separately. And you can't, if you choose married filing separately, then you're not going to get any earned income credit if you were to qualify for it in any case. Number 4, you must meet a U.S. citizen or resident alien all year. You must be a U.S. citizen or resident alien all year. Number 5, you cannot file Form 2555 or Form 255EZ, foreign income. Number 6, your investment income must be $3,500 or less. So these are the general requirements, and the last one, you must have earned income. So you have to have some earned income. You have to have, in order to get the earned income credit. So remember how that works. The credit goes up as your earned income goes up, and then of course as you hit a cap at some point of your income, it flattens off and then goes down as your income goes up from there. So we'll discuss that, the calculations of it more within examples. These are the 7 rules, however, that everybody must meet. If you meet these, then we go on to the rules that will then split between whether you have a qualifying child or not a qualifying child, and so on and so forth. In this presentation, we'll take a look at some adjusted gross income limitations with regard to the earned income credit. This is coming from publication 5/9. So here we're on rule 1 of our 7 rules, which is the adjusted gross income limitation. Your adjusted gross income must be less than, we have the $49,194 or the $54,884 for married filing jointly if you have 3 or more qualified children. Let's test that out in our test 1040. So we have Adam Smith. It's going to be head of household instead of married. We've got the 3 dependents, dependent 1, 2, and 3, qualified children. We're going to say, all right, if that's the case and there's $20,000 of income, that's going to be the W-2 income. No adjustments. Therefore, the AGI is $20,000 as well. We're going to say that then they're going to have the standard deduction of the 18,000, meaning $2,000 of income. The tax then at 201. Tax at the 201, and then we're not worried about this child tax credit, but that brings it down to 0. That's going to be a child tax credit because of the children, but we're really concerned here with the earned income credit. So here is the earned income credit, still getting the earned income credit even though the tax is down to 0, and obviously this is the case where they're qualifying because they're at 20,000 of income. So earned income, what if that goes up and we say, all right, well, what if the earned income now is 30,000 of earned income? What does that do to, I'm just plugging this into the software and saying, okay, well now the earned income credit goes down to 4,037. All right, well what if we made 40, what if we said 40,000? Notice the earned income credit's going down now. That brings it to 1,931. And what if we bring it to that cap? Remember the cap was, well, let's go to 49,194 of earnings, and that should bring it down to 0. So now the income there is at 0. And we can say, okay, what if they were married? So now we have a married return, Adam, the 2 Smiths here, and we still have the 3 children, and now we have that 40 now, what's the cap before, but now they're married. So now we have a different item, and so we still have some earned income credit. We're not getting into the calculation of it now. We're just saying there's some there. And then if we increase our income from there, remember the cap was 54,000. So if we increase our from to 53,000, let's be right under it, then we're going to say, okay, so now we still have some earned income credit, and if we bring it up to the cap of the 54,884, then the earned income credit should disappear. So there's just some evidence on the software to give us some idea of what's going on here. Now, if you had the second item, what if we only had 2 children? Then we'd have the 45,408 and the 51,492 would be our cap. In other words, if we go back to our head of household, 1 person, head of household, 2 dependents now. So now we have the 2 dependents instead of 3, and we have the 20,000 of income. Now we have 20,000 of income, and 18,000 is the standard deduction, 2,000 of taxable income. So that's the 201 we saw before. The child tax credit is bringing it down to 0. We're concerned here with the earned income credit. So there's the earned income credit at 20,000. Again, if we increase this up and we say, all right, we're going to go more towards the cap with the 2 children, how about 30,000 for the one person, the single individual? That of course brings it down, but we still have it, right? And if we go to the next item, we say, all right, how about 40,000 of earned income? We're going to say, all right, that brings it down, but it's still there. And then the cap for the single was 45,802. That's when it should basically disappear, right? So that's when it goes away. Now, what if they were married? Now we have married, filing joint. We got the 2 returns. We got the 2 dependents now. So we're still at that 45,802, which was the cap for the head of households for the one person. But now we have the exemption of 24,000 and whatnot. And we'll go down here. So the earned income credit is now still on the books because, of course, now we have the married status. And if we change the amount of income, then we're going to say, all right, well, what happens if we're at 50,000, which is close to the cap for 2? Then we still have a little bit there. And then if we go to the cap, then it should cap out at, we said 51,492. So notice how you can kind of use software to basically test what the code is saying. Back to the text, if we have 40,320 and 46, if you have no or only one qualifying child. So here's the cap, 40,320 or 46 if married, if we have one qualifying child. So what does that mean? So we'll go back to the Adam Smith. We got the head of household status here and just the one qualifying child. So here we have, if we scroll down back to the 20,000, there's our 18,000 of the standard deduction, 2,000 income. And then here's our tax 201, the child tax credit wipes that out. And then we're at the earned income. So we have the earned income credit of 3,243, which is what we're concentrated on here. And we can say, all right, well, if we increase the income then to 30,000 with the one child and the head of household status, not 3,000, but 30,000. And we go back over and say, well, what does that do to the earned income credit? Well, we still have the earned income credit here. And then if we increase it, let's say to 35,000, we're going to say, what does that do? 35,000 brings it down. And the cap was at the 40,320. And that'll bring us, that should wipe it out, 40,320 if they were married. So now we have a married return with the one individual there. So we have the married return and the one child. Now that we had the same income that was maxed out, but now the filing status has changed. And so we can see that we now, again, have the earned income credit has reappeared now at the 908. And then if we increase the wages from there, we're going to say, all right, well, what happens if we go closer to the cap? Let's say 45,000, which is pretty close. Then we're going to say, okay, it goes down to 157. And then, of course, if we go up to the 4610, that's the cap, and that should basically wipe it out here. So now that takes it away. So that's basically the kind of the caps in action. The same would be if it would be 15,270 and 20,950 if we were had no children. And so we won't go through the scenario there. I think we did that in a prior presentation. So similar kind of scenario would be there if we had no children. Adjusted gross income. AGI is the amount on line 7. So note what we were looking at is, of course, the amount on line 1 and line 7 being in essence the same. Total income, it's all W-2 income. It's possible for these two items to be different. Line 7 could differ from line 6, total income and adjusted gross income, if we had any items in the Schedule 1, these types of above-the-line deductions. So these types of above-the-line deductions could have the difference there. So if your AGI is equal to or more than the applicable limit listed above, you can't claim the earned income credit. You don't need to read the rest of the publication. For example, if AGI is more than limit, your AGI is 40,550, you are single, and you have one qualified child. You can't claim the earned income credit because your AGI isn't less than the 40,320, as we've seen in our examples here. However, if your filing status was married filing joint, you might be able to claim the earned income credit. So note that's similar to our example that we had here, where we said, okay, it met the single, too high to be there for non-married filers, but could be there for the married filer, given the fact that the AGI limit is typically higher for the married filers than the non-married filers. In this presentation, we will discuss the requirement of must have a valid Social Security number as it relates to the Earned Income Credit, EIC credit. This is from publication 596. We're on the Rule 2 of the 7. These are the 7 mandatory rules. We are now on Rule 2, which is you must have a valid Social Security number, SSN. This seems pretty straightforward, but there are actually some nuances here. So if this is applicable to you, we'll go through some of the nuances and you can check out the publication related to them. So back to the text. To claim the EIC Earned Income Credit, you and your spouse, if filing a joint return, must have a valid SSN, Social Security number, issued by the Social Security Administration, SSA, by the due date of your 2018 return, including extension. So that means, of course, that the due date is typically on the 15th, but then you can have an extension that would be basically out until October. So you could just keep in mind that you have that extension available. Back to the text. Any qualified child listed on the Schedule EIC Earned Income Credit also must have a valid SSN Social Security number by the due date of your 2018 return, including the extension. See Rule 8 if you have a qualifying child. So Rule 8 deals with the qualifying child. Back to the text. If your Social Security card or your spouse's, if filing a joint return, says not valid for employment, and your Social Security number was issued so that you or your spouse could get a federal funded benefit, you can't get the Earned Income Credit. If you have a card with the legal not valid for employment or your immigration status has changed so that you are now a U.S. citizen or permanent resident, ask the SSA, Social Security Administration, for a new Social Security card without the legend. Next item, U.S. citizen. If you were a U.S. citizen when you received your Social Security number, you have a valid Social Security number. Valid for work only with INS authorization or DHS authorization. If your Social Security card reads valid for work only with INS authorization or valid for work only with DHS authorization, you have a valid Social Security number, but only if that authorization is still valid. Social Security number missing or incorrect. If an Social Security number, SSN, for you or your spouse is missing from your tax return or is incorrect, you may not get the Earned Income Credit. Note that the IRS, if it doesn't register within the system, the Social Security number, you're probably just going to get a letter. It probably won't go through their system. You may not even be able to file with the electronic filing system. And if you paper file, you're probably going to get a letter, or most likely the system will kick it back. If an SSN, Social Security number for you or your spouse, is missing from your return because either you or your spouse didn't have a valid Social Security number on or before the due date of your 2018 return, including extension, and you later get a valid Social Security number, you can't file an amended return to claim the Earned Income Credit. So in other words, you may not still be able to get the Earned Income Credit because they're specifically saying here that you got to have the valid Social Security number by the time you have to file, so April 15th, or the extension, which is typically October 15th, out. And then if you don't do that, typically, oftentimes you have the ability to amend the return for many other kind of things that could happen, any changes. But they're explicitly saying that in this case, not generally the case, because they're not going to allow that particular case. So that means that, of course, if the Social Security number is an issue, got some time to deal with that. It's probably a long issue to get a Social Security number given the bureaucracy of getting a Social Security. But in any case, you want to get it before the filing of the return, but there is an including of an extension to do that, which does give a significant amount of time. Back to the text. Other taxpayer identification number. You can't get the Earned Income Credit if, instead of an SSN, Social Security number, you or your spouse, if filing a joint return, have an individual taxpayer identification number, an ITIN. So let's read that again. Individual taxpayer identification number, the ITINs, are issued by the Internal Revenue Service to non-citizens who can't get the SSN Social Security number. No SSN if you don't have a valid SSN, Social Security number, on or before the due date of your 2018 return, including extensions. Enter no in the space to the left of line 17, Form 1040. Here's line 17 on the Form 1040. That's basically where these kind of credits would typically be at. So we'd have these credits that would be down here that could give a refund typically beyond the point of us paying any taxes. So that's where line 17 is. You can't claim the earned income credit on either your original or amended return. So getting an SSN, Social Security number, so if we don't have one, obviously, then, well, how can we get one here? So if you or your spouse, if filing a joint return, don't have a Social Security number, SSN, you can apply for one by filing an SS5 with the SSA, Social Security Administration. So you want to go to the SSA website. You can get the form SS5 online so you want to go to the browser, ssa.gov. So within the browser, instead of www, just ssa.gov in the browser, Google Chrome or something like that, from your local SSA office or by calling the SSA here's their number. Filing deadline approaching and still no SSN Social Security number. If the filing deadline is approaching and you still don't have a Social Security number, you can request an automatic 6-month extension. So that's one of the options that are there to get basically the 6-month extension of time to file. You got to file for the extension of time to file your return. You can get the extension by filing Form 4868. So you could find that on the Internal Revenue website. It's just basically an extension form. So 4868, so you can go to irs.gov typically and possibly file an extension form there. Application for automatic extension of time to file U.S. individual income tax return. For more information, see the instructions for Form 4868. You can also find the instructions on the IRS website. Instead of filing Form 4868, you can apply for an automatic extension by making an electronic payment by the due date of your return. So if you owe any money, you can also make an electronic payment. But the 4868 you can find, it's pretty straightforward form. Again, irs.gov. In this presentation, we will look at the requirement for the earned income credit of filing status cannot be married filing separately. This is coming from the publication 596. These are our 7 major rules that everybody must follow in order to look and see if we qualify for the earned income credit. We are now on Rule 3 of 7. Your filing status cannot be married filing separately. Now, of course, that one's pretty straightforward, meaning we can't file a married filing separately. So, in other words, if we had our tax return and we were married, if we were a married couple, for example, here is our test 1040 and we have the married filing status here. We have another option. We can't file single. We can't, if we want to think, well, what can we do here to kind of see what we can do to maximize our benefits? Well, if we're already married, if we're legally married, the IRS sees us as one entity for basically taxes, and you're supposed to file, they would think, married filing joint. However, they do give this married filing separately, and there's some benefits that could happen to the married filing separately, but they also restrict things because they don't want it to be taken advantage of. What you can't do, in other words, is you can't jump over to single status without getting divorced, right? And that would be something different. So you can't jump over to head of household status or qualified widower status if you're married, right? That doesn't work. But you can go to the married filing separately without basically getting divorced or anything like that. However, you'll basically lose the child tax credit. So in other words, if we saw this item here, we've got the one child for the married return. We're saying $20,000 of income, AGI $20,000. Then the standard deduction is $24,000, bringing the taxable income to 0. We still have the credit, so there's still a refund here of the credit. We're not going to get into the calculation of the credit. Just note that there's a credit now, basically for it. Now, the only thing we could do then is we could say, well, what if I had 2 returns for married filing separately and try to break this out? So if I go back to the details and say, what would happen if we said filing status, married filing separately, and we go back over, and we're going to say, even though the $20,000 is low, married filing separately, we still have the one child on there, and we have the $20,000, we're not going to get the earned income credit. Earned income credit is gone now. So that's the issue. Whereas if we were single, like if we got divorced, in other words, then we would still have the credit, right? If we go back over and we say, well, what if they were divorced and we said that we had the filing status as single or head of household? Let's say head of household more likely if we still had a dependent. So we'll say now head of household. So this is something you can't do unless you got basically separated, somehow legally separated. So now we'll say head of household. We've got the single and the same 20,000 of income. Now the credit is there. So in other words, so the IRS is basically saying you can't just jump from married filing jointly to separated filing separately, just simply to kind of play around with what the income levels would be to get this fairly significant credit down here. And so you can't really do that. So that's something to just be aware of. Back to the text. If you are married, you usually must file a joint return to claim the earned income credit. Your filing status can't be married filing separately. Spouse did not live with you. If you are married and your spouse did not live in your home at any time during the last 6 months of the year, you may be able to file a head of household instead of married filing separately. In that case, you may be able to claim the earned income credit. For detailed information about filing as head of household, see Publication 501, Dependents, Standard Deduction, Filing Information. So note what it's getting into here. It's basically saying, if you're married, you live together, and everything is, as married, you can't generally file something other than married or married filing separately. We're not going to give you the credit if you file married filing separately. And then there's an issue of, well, what if we're kind of legally, so what if we're married, we never really got divorced, but we're basically not living together? Well, now you're getting into the issue of, well, are you kind of legally separated or whatever? And now the question is really, can you file as a head of household filing status under that case? And that's kind of a different issue that you'd want to look into. Can you file as a head of household instead of married? And of course, once you do that, then you'd want to think about both individuals that are involved in the tax return. Obviously, you don't want one person filing as married and the other person filing as head of household, or you don't want one person filing as married filing separate and the other person filing as head of household or single. If you're filing as separated, you want to make sure that you can legally file as separated, and then the two people that are filing should be filing as either single or head of household under those conditions. So for more detail on that, you want to think about the filing statuses and when you'd file married or versus when you can file it as a separate single or head of household status. In this presentation, we will take a look at one of the requirements related to the earned income credit, that being must be a U.S. citizen or resident alien all year. This is from Publication 596. So we're now looking at those 7 rules, those rules that basically apply to everyone, concentrating here on rule number 4, which is you must be a U.S. citizen or resident alien all year. So that's fairly straightforward. We'll go through some of the text from the publication. Back to the text. If you or your spouse, if married, were a non-resident alien for any part of the year, you cannot claim the earned income credit unless your filing status is married filing jointly. You can use that filing status only if one spouse is a U.S. citizen or resident alien and you choose to treat the non-resident spouse as a U.S. resident. If you make this choice, you and your spouse are taxed on your worldwide income. If you need more information on making this choice, get Publication 519, U.S. Tax Guide for Aliens if you or your spouse, if married, were a non-resident alien for any part of the year and your filing status isn't married filing jointly. Enter no in the space on the left of line 17. And again, line 17 is this item down here, which relates to these credits that might give a refund above and beyond typically the amount that would be owed. In other words, in this case, the tax owed is 0 up to this point, right? No, there's a liability and it got wiped out from the child tax credit, and then these credits would still get a refund even though it's below that amount. And so that's where the line 17 are. So note, of course, we have some kind of issue here. I mean, the confusing thing with this basic status, you must be a U.S. citizen, is the case of, well, what if we're married and we have the one individual as a U.S. citizen? And so then you got to look at the filing status for those conditions. So that would be the condition you want to look into. And again, if you need more information on making this choice, you can go to publication 519. You can go to the irs.gov website to find that publication. In this presentation, we will take a look at the Earned Income Credit requirement of cannot file Form 2555 or Form 255EZ. This information is coming from publication 596. We're considering those 7 conditions we must meet in order to see if we qualify for the Earned Income Credit. We are now on the Rule 5. Rule 5, you cannot file Form 255 or Form 255EZ. Back to this text. You can't claim the Earned Income Credit if you file Form 255, which is the Foreign Earned Income, or Form 255EZ, Foreign Earned Income Exclusion. So the form looks like this. If you have Foreign Earned Income, Form 255, then that means that you've got income from typically a foreign source income, and they're going to limit basically the Earned Income Credit in that case under those circumstances. You file these forms to exclude income earned in foreign countries from your gross income, or to deduct or exclude a foreign housing amount. U.S. possessions aren't foreign countries. See Publication 54, Tax Guide for U.S. Citizens and Resident Aliens Abroad for more detail and information. So just be aware of that information. You want to note that the reasoning behind this is likely to be, if we have foreign income and then we have a limited amount of income in the U.S., then it's possible that this foreign income got excluded from the calculations of income that we're going to be taxed on in the U.S., and therefore, even if we have a low income in the U.S., then we could have a significant income given the fact that we have basically foreign income. So the fact that the Earned Income Credit is for basically low income are individuals that possibly need more support, then the Form 255 disqualifies, possibly simply because it's likely that there's income elsewhere outside the U.S., and therefore it doesn't meet kind of what the goal or the spirit of the law is. In this presentation, we will take a look at the rule of investment income must be $3,500 or less related to the Earned Income Credit. This information from publication 596. We're considering the 7 rules that it's going to apply to everyone related to the Earned Income Credit. We are now concentrating on Rule 6. Your investment income must be $3,500 or less. So you can't claim the Earned Income Credit unless your investment income is $3,500 or less. If your investment income is more than $3,500, you can't claim the credit. Now, there are some nuances here. We can use Worksheet 1 if this chapter to figure out your investment income. Let's just take a look at a general example here, though. Here's our test 1040. Here's our individual. We have head of household status. We've got the one child that's a qualified child. If we scroll down, we're saying $20,000 of income, and that gives a standard deduction of $18,000. The tax income of $2,000 given a tax of $201. That's being wiped out by the child tax credit. And then we have this Earned Income Credit down here. Again, we're not looking at the amount specifically and how to calculate it. We're just considering, well, now what would happen just in terms of the tax software, which is increased investment income. Now, investment income, you're typically thinking of something like interest income or dividends are the two kind of most common investment income. So, for example, what if we had interest income of $3,000? That would mean we got something from the bank reporting that we had interest income typically of $3,000, which is a lot. I mean, we'd have to have pretty good investments to have $3,000 of interest income, which is the point, because if there's a lot from interest income, that would mean typically we would have a lot in the bank, right? And they're saying if you have a lot of assets, then you shouldn't really qualify for the Earned Income Credit, which is given so to people that are possibly need the income more. So if we have $3,000 here of interest income, we're going to say if we scroll down, we still have that 2,706 and still remains. Okay, so let's increase it to 3,499, which is pretty close to the limit. So now we're at 3,499. It's part of total income. It's increasing the adjusted gross income here and the total income, but it didn't wipe out the credit yet. And if we go to 3,500 on the bank, and we scroll up, now it's at 3,500. Credit's still there. Then if we jump, what if we jump to 3,501, and we go back up, And we're going to say now the credit's wiped out. So notice this is just kind of a hard line. That $1 obviously of interest income is just, it's just going to be a hard line. If you're over that 3,500, then it wipes it out completely. And then you might think, well, what if you were married? You know, what if you were married here? So now we have two individuals, the one, and we have the one dependent, and now we're married, and we only, let's say we have 3,000 of the interest. So 3,000 of interest below the limit, then we still have, of course, our earned income credit. Well, what if I hit that same limit of 3,501, 3,501, and we're married now? You would think the limit would be higher, but no, it's still that 3,500. So it's just a hard, it's kind of a funny thing for the tax. It doesn't matter if you're married or single or what the filing status is. It's got that hard limit of that 3,500. Now, the same thing is true with dividends. Dividends are another typical type of investment income. If we had dividends, we invested in stocks and bonds and we got dividends, more likely to get over 3,500 from dividends. So then we're going to say, oh, well, if it's 3,000 of dividends instead of interest, then we scroll down, it's still calculating the credit in our software. But the same thing happens if we go to 3,500, 3,501, then the credit's going to be wiped out because the dividends are up above that amount. And what if you had a combination of the two? What if we had dividends and investment income? Or dividends and interest, I should say, which are both types of investment income. So if we scroll back down, now we're going to say we got 1,000 of interest and 2,000 of dividends, under 3,000 total. And then again, we're back to being able to have the credit because we're not up above the 3,500 between the two of them. But if we change this 1 to 1,501 now, and then I go back over and we're going to say, all right, well, now we've got 2,000 of ordinary dividends and the interest 1,501, and that's going to bring us over the 3,500, and now the earned income credit is wiped out. So that's just basically how you can kind of work that out and see that within the software. If this is applicable, you can go through Worksheet 1, which is the investment income. We're not going to go through this basically line by line, but you'll note that we have the interest and dividends, we got capital gains items, we've got the royalties and rental income items. Again, we're not going to go through the entire process here. Worksheet 2, worksheet for line 4 of Worksheet 1. Again, we won't go through the whole thing. Here's an example. And this is going to be a bit more complex because now we're saying that there's going to be a child, and if we have a child that has some type of investment income, in other words, we have a child and we set up some passive income, some investment income such as money in the bank or money that's in investments for them, then we might report some of their income on our return for that. And then you have some kind of a special case in this case. Again, if we were applying for the earned income credit, typically you would think that the child would not have much, passive income, a lot of money in the bank. So usually probably nothing, but this would be a more complex type of example if you wanted to go through this example, if there's some situation that's a bit more complex that applies to you with regard to investment income. In this presentation, we will consider the condition of must have earned income with relation to the earned income credit. This information from publication 596. We're looking at those 7 rules that need to apply in order to see if we qualify for the earned income credit. This is part of the qualifications, and we're considering now the rule number 7, must have earned income. Seems pretty straightforward. We have to have earned income. It's called the earned income credit. However, it's not straightforward because we have to then define what is earned income and what isn't earned income, because you'll note now that there's gonna be this idea where the credit actually goes up as we have more earned income and then tapers off and then goes down as our earned income or income increases past that point. So in essence, like something like that. So obviously the incentive for someone trying to is to maximize the credit to be up here, which means that if we have earned income down here, then we're actually trying to report more income, which is unusual for taxes. Usually you're trying to go to the tax person saying, hey, I don't have any money. Don't take my money. I don't have any. You don't typically go to the tax person saying, hey, look, I have more income, right? Which is, just in kind of theory, you don't typically look for more income that you could report on your taxes. That's kind of weird. But with the earned income credit, you kind of do up to this point. If you're looking actually to maximize up here, and then past that point, then you're doing what traditionally is done with taxes. You're trying to find things that you don't have. You don't want to report the taxes at that point. So now that you have, so now if you have this condition, you've got this, well, what are those things that are counting in terms of earned income and which are not? And are there any types of things that are flexible that we could use to, to increase the earned income if we want it to increase the earned income, to increase the earned income, to earn income tax when necessary? Or are there any of those things that we can actually remove with regard to the earned income tax? It's legal to do so. So now the incentives are kind of a little unusual with regard to the earned income, and we have to define what earned income is then. Back to the text. This credit is called the earned income credit because to qualify, you must work and have earned income. If you are married and file a joint return, you meet this rule if at least one spouse works and has earned income. If you are an employee, earned income includes all the taxable income you get from your employer. So that's going to be the most standard, of course, definition. I mean, if we work somewhere and we're working within the U.S. and everything is straightforward, we got a W-2 income. For example, this is our $20,000 W-2 income. Then that's basically straightforward. We would say, okay, then we have the $20,000 of W-2 income, and that would be typically earned income. And if we scroll down, we're not concentrated on the amount of the credit, but we would typically think, yeah, that would qualify for some type of credit down here, or that would be something that would count towards the qualifications for the credit. If, however, the income is zero, then obviously we have no earned income because we have no income at all, right? We have no income at all, and therefore it's not worth filing even if we don't have to, because there's not going to be any earned income credit. And again, you might think that's unusual because the earned income credit is supposed to help people basically that have lower income, but it's trying to also incentivize people to have some earned income. But then you might think, well, what if I had earned income, somewhere else? Or what if I had income somewhere else? The question is it earned or not? For example, if we had income, we had to report income, typically that's dividend income, but it doesn't qualify as earned income. So even though it's less than the $3,500 investment limit, it doesn't help us out with regard to the earned income credit because it's not earned income. It's not qualifying as earned. If I had that same $3,000 and it was W-2 income, see, now we just moved it up here to the typical W-2 line 1 instead of dividends, and that would typically qualify for earned income. So, even if I had that 3,000, so now the earned income is 1,029. If I had that W-2 income and the dividend income of 3,000, well, now the total income is 6,000, 3,000 of W-2 and 3,000 of the dividends, but it didn't have an impact on the earned income credit because that other 3,000 isn't part of the W-2. It's not earned income. Now, if it was, what if I had 6,000 in here in earned income and no dividend, no ordinary dividend? So now we got 6,000 in the earned income, and you can see the software actually increases. So that actually the amount of the credit is increasing with the earned income. So given that fact, we'll talk about tables and what maximizes out the credit and what's not. We're not concentrating on that now. It's going to be a variation of multiple things, including the dependents and the filing status and whatnot. But just note that it actually tends to increase as the earned income goes up. So we need to determine what's earned and what's not earned, and is there any kind of wiggle room in any area where we might have something that we could report or not report it, so that we could legally maximize the earned income credit. Back to the text. Rule 15 has information that will help you figure the amount of your earned income. If you are self-employed or a statutory employee, you will figure your earned income on EIC Worksheet B in Form 1040 instructions. So if we're self-employed, basically have our own business, we have to Schedule C income, then that could complicate things in terms of our earned income as well. Earned income, back to the text. Earned income includes all the following types of income. So these are the things that specifically within this publication are part of earned income. So part of earned income, 1, wages, salaries, tips, and other taxable employee pay. So obviously all the normal stuff you would think. If you get a W-2 income, if you're working as an employee, then obviously you would think that that would be reported on your W-2, and therefore it would also be part of the earned income. Employee pay is earned income only if it is taxable. So it's only, we're looking at the taxable portion of the amount, the earned income. So things that are not taxable, like benefits, may not be included in the earned income. So non-taxable employee pay, such as certain dependent care benefits and adoption benefits, isn't earned income. So if dependent care or adoption benefits, not earned income. But there is an exception for non-taxable combat pay. So the non-tax, so they're going to give that special exception here for the combat pay. So that's one area where we could have some wiggle room in terms of what we do with the combat pay. So which you can choose to include in earned income. So notice this key term, choose. Well, that implies that we could put it in there or not. And remember how that bell curve or not bell curve specific, but how the curve kind of goes up and drops off. We may, in terms of the earned income credit, want to or not want to include it. So as explained later in the chapter. Number 2, back to the text. Net earnings from self-employment. So that's going to be another item that will be included as part of the income that's earned income. So let's take a look at an example of that. Often that is something reported on a Schedule C. So if we had a small business here and we had like a Schedule C, and so this is a net profit from the business. We usually have, this was easy, a Schedule C easy if it was a very basic Schedule C. But in any case, if we had our own business, we typically would have a Schedule C. Then we have the net income from the Schedule C that would then pull over to the 1040. The 1040 would be here. It's on line 6. We've got the 10,000. If we go to Schedule 1, we'd also report the business income on line 12. And then we'd go back to the 1040 and say, all right, so there's our income. And that's going to be counting for the income that's going to be self-employed. And therefore, again, we're not getting into the amount of the credit right now, the calculation, but just note that the software is showing a calculation for the credit based on simply the earned income from the business, not from W-2 income. Back to the text. Gross income received as a statutory employee, wages, salaries, tips, wages, salary, and tips you receive for working are reported to you on Form W-2. So this would be the most straightforward way, of course. The W-2 income, we'd get the W-2. That would be part of earned income, typically. You should report these on Form 1040 line 1. So that's what we did last time, the typical type of reporting that we would have, reporting the income from the W-2 in line 1, wages, salaries, tips, etc. Back to the text. Non-taxable combat pay election. So this is kind of an unusual circumstance, but one that if it's applicable, you want to be aware of. You can elect to include your non-taxable combat pay. Notice it's not taxable as combat pay. So, but you can elect to include it, combat pay in earned income for the earned income credit. So we could elect to include it, which could increase the credit. So the amount of your non-taxable combat pay should be shown on Form W-2 in box 12. So when you get your W-2, if you got box 12, if it indicates a Q, then you might have some leeway to basically increase or decrease. And you want to be very aware of that because it could have a significant impact on your tax return with regard to the earned income credit. Electing to include non-taxable combat pay in earned income may increase or decrease your earned income credit. Let's take a look at an example of this. If we got our Form 1040 and we've got our head of household individual here, and then we have our standard, our one child, qualified child, we're going to say, let's say there's 5,000 of wages. So we have 5,000 of wages that were on the W-2, but then we also had some combat pay, which we're going to say is 3,000. So we'll include that in a bit. So here's 5,000. The combat pay is not included right now because it's not taxable typically. And so we don't have it here. And then we're going to say that the standard deduction is here. No tax is paid, but we still have this credit of 1,709. Now, in this case, we might say, well, we're not paying any tax liability. I'd actually like to increase this number because if this number going up would actually increase my refund because I'm not paying any taxes and I'm still getting a refund back partially, mainly because of the earned income credit. If I can increase, if I have 3,000 of combat pay, I would actually want to increase this possibly. So if we go back over and say, well, let's take the 3,000 of combat pay that we have reported here and include it. So I'm going to say elect to include 3,000 of combat pay over and above the 5,000 that's not included, and go back to our return. You'll note it doesn't increase the amount reported here for the W-2. It doesn't increase the tax liability at all, the amount of tax liability that's calculated, but it increased this earned income credit in the software. Now we have the NCP of the 3,000 for the combat pay. So that, of course, can be significant. Now let's adjust this and say, you might say, well, why wouldn't I include it all the time then? Well, if we adjust this and we say, okay, here's the same return, but now we're going to say that the 30,000 was earned without the 3,000 combat pay. And then if we scroll down, now we have some tax liability, but it gets wiped out by the child tax credit to 0. And we still have this earned income credit 1645 in this case. Now we're not including the combat pay here. What if we go back, and so remember that's 1645, and we say, all right, now we want you to include the combat pay. So if we go back to our item and say we have 3,000 of combat pay, and we want to elect to include the non-taxable combat pay, and then go back up. Notice it's not changing this number for the tax. It's not changing the liability, but it actually decreased this 1166. So we wouldn't want to do it in that case. We would want to not do it because the combat pay would be decreasing here. So this is one area where we could have some leeway between the returns as we go back and forth between the returns. You want to be aware of that. So let's go back to our text. Net earnings from self-employment. You may have net earnings from self-employment if you own your own business or you are a minister or member of the religious orders. We took a look at that in the prior example with the Schedule C income. Minister's housing. The rental value of a home or housing allowance provided to a minister as part of the minister's pay generally isn't subject to income tax, but is included in net earnings from self-employment. For that reason, it is included in earned income for the earned income credit. So again, if you're in that special kind of condition where you have the minister's housing, then you want to look at those special tax rules there. Statutory employee. You are a statutory employee if you receive a Form W-2 on which the statutory employee box 13 is checked. So if you look at your W-2 and you see box 13 checked, then you want to look into that, research that. You report your income and expenses on a statutory employee on Schedule C. So that once again would be on basically the Schedule C income, which is typically where you report business income. Strike benefits. Strike benefits paid by a union to its members are earned income. So if you're if you're on strike, if you were on strike during the year at some point and the union paid, then they're also saying that's earned income, even though obviously you're not going to work, you're on strike. They're saying that that is going to be included in earned income. And again, there's no leeway. They're not saying that it could with the combat pay be included or not. They're basically saying that should be included in income. Approved Form 4361 and Form 4029. This section is for persons who have an approved Form 4361 application for exception from self-employment tax for use by ministers, members of religious orders, and Christian Science practitioners. Again, if you're in that kind of special area, then you're probably aware that you got some kind of unusual or different tax regulations you want to look into. Form 4029, application for exemption from Social Security and Medicare taxes and waiver of benefits. Each approved form exempts certain income from Social Security taxes. Each form is discussed here in terms of what is or isn't earned income for earned income credit. So again, these are very kind of special conditions. Form 4361, whether or not you have an approved Form 4361, amounts you received for performing ministerial duties as an employee count as earned income. This includes wages, salaries, tips, and other taxable employee compensation. If you have an approved Form 4361, a non-taxable housing allowance or non-taxable rental value of a home isn't earned income. So again, the home for for the housing of the home, they're saying that is not earned income. Also amounts you received for performing ministerial duties, but not as an employee, don't count as earned income. Examples include fees for performing marriages. Form 4029, whether or not you have approved Form 4029, all wages, salaries, tips, and other taxable employee compensation count as earned income. However, amounts you received as a self-employed individual don't count as earned income. Also, in figuring earned income, don't subtract losses on Schedule C, CEZ, or F from wages on line 1 of Form 1040. Then we have disability benefits. So back to the text. If you retired on disability, taxable benefits you received under your employer's disability retirement plan are considered earned income until you reach minimum retirement age. So if have disability, you want to basically make sure you're taking a look at this with regard to the earned income. Minimum retirement age generally is the earliest age at which you could have received a pension or annuity if you weren't disabled. You must report your taxable disability payments on line 1 of Form 1040 until you reach the minimum retirement age. Beginning on the day after you reach minimum retirement age, payments you received are taxable as a pension and aren't considered earned income. Report taxable pension payments on Form 1040, lines 4A and 4B. Again, whether it's taxable income or not can be beneficial or not, depending on where we stand with regard to any other income at that time. Disability insurance payments. Payments you received from a disability insurance policy that you paid for premiums for aren't earned income. It doesn't matter whether you have reached minimum retirement age. If this policy is through your employer, the amount may be shown in box 12 of Form W-2 with code J. Income that is not earned income. Examples of items that aren't earned income include interest and dividend, pensions, and annuities, Social Security. So these are items that specifically we'll see on the tax return, and we saw some examples of them before. So if you go back up here in the earnings area, specifically the investment income, the interest, and ordinary dividends are going to be items that are showing up here that aren't part of earned income. So if it says specifically in the code and in our publication that it's not earned income, then of course it wouldn't be earned incomes, and that includes dividends, pensions, annuities, interest, and Social Security. And railroad retirement benefits, including disability benefits, alimony and child support. So alimony and child support aren't included as earned income. Welfare benefits, workers' compensation benefits, unemployment compensation, insurance, non-taxable foster care payments, and veterans benefits, including VA rehabilitation payments, don't include any of these items in your earned income. So again, if you have any of those kind of items that you're questioning whether you should include them or not, hopefully as you enter them into the software, if you have tax software, it'll help you to kind of figure that out for you. But you want to go over here and see directly whether or not they should be included if you have questions with them as you fill out the earned income credit. Earning while an inmate. Amounts received for work performed while an inmate in a penal institution aren't earned income when figuring the earned income credit. So again, they don't want to give any benefits to people that are in prison or in violation of laws and whatnot. However, the fact that it's not included in earned income could be a benefit or not, depending on how high the earned income is prior to that. So continuing on with the text, this includes amounts for work performed while in a work release program or while in a halfway house. Workfare payments. Non-taxable workfare payments aren't earned income for the earned income credit. These are cash payments certain people received from a state or local agency that administers public assistance program funded under the Federal Temporary Assistance for Needy Families program in return for certain work activities such as 1. Work experience activities, including remodeling or repairing public housing if sufficient private sector employment isn't available, or 2, community service programs. So that would be a specific condition for the workfare payments. And again, whether it's included or not could be a benefit or not, depending on our circumstances. Community property. If you are married but qualify to file as head of household under special rules for married taxpayers living apart. So again, we got that kind of special condition of, you're married, typically you can only file married or married filing joint, but what if you have kind of a special condition, you're filing in more of a single status, a head of household type status, and live in a state which has community property laws, your earned income, EIC, doesn't include any amount earned by your spouse that is treated as belonging to you under those laws. That amount isn't earned income for the earned income credit, even though you must include it in gross income on your income tax return. So that's quite an unusual circumstance here, right? So we're married, we're filing as not married, and then we could have this condition where it'd be reported for income but not earned income. So if that's a condition that you're into, you want to make sure you're researching here on that, looking into that further. Is it proper to file as head of household? And if so, how do you deal with the with the income distribution? Your earned income includes the entire amount you earned even if part of it is treated as belonging to your spouse under your state's community property laws. So then we got some specific states: Nevada, Washington, and California, domestic partners. So now we're specific to Nevada, Washington, California. If you are a registered domestic partner in Nevada, Washington, or California, the same rules apply. Your earned income for the earned income credit doesn't include any amount earned by your partner. Your earned income includes the entire amount you earned. For details, see the publication 555 if that applies to you. Conservation Reserve Program, the CRP payments. If you were receiving a Social Security retirement benefit or Social Security disability benefits at the time you received any CRP payments, or CRP payment aren't earned income for the earned income credit. So again, if that's a specific requirement for you, there you go. Non-taxable military pay. Non-taxable pay for members of the armed forces isn't considered earned income for the earned income credit. Examples of non-taxable military pay are combat pay, the basic allowance for housing, and the basic allowance for subsistence. See Publication 3, Armed Forces Tax Guide, for more information. So Publication 3 on the IRS.gov for that. Combat pay, if you can elect to include your non-taxable combat pay in earned income for earned income credit. So note, that's that one that's really kind of flexible. So if that's something that applies to you, you're going to have to do some testing to see how to maximize your pay there. It could be worth doing in some cases for sure. See non-taxable combat pay in Chapter 4. In this presentation, we will take a look at rules if you have a qualifying child related to the earned income credit, these being from publication 596. Rules if you have a qualifying child. If you have met all the rules in Chapter 1, use this to see if you have a qualifying child. So in other words, there's going to be certain rules that we need to all get past. It's going to be those 7 major rules for everybody. And now we're kind of in the fork of the road to decide, all right, well, now we qualify so far. What about this situation where I have a qualifying child or not? So now we're talking about the situation where we have a qualifying child as opposed to one in which we do not. So back to the text. This chapter discusses Rule 8 through 10, which have to do with this format of the fork in the road, the qualifying child. You must meet all 3 of those rules in addition to the rules in Chapter 1 and 4 to qualify for the earned income credit with a qualifying child. So again, we're moving on to basically these rules specific to the qualifying child rules, and of course those are in addition to the rules that would apply to everybody. Back to the text. When you file 1040, you must attach Schedule EIC to your return to claim the earned income credit with a qualifying child. If you meet all the rules in Chapter 1 and this chapter, read Chapter 4 to find out what to do next. It's kind of like a suspense novel where we get to choose our own journey and whatnot. It's great. So we're going to go over here. Then we've got the Form 1040. Note that if we have the qualifying child then in our example problem, they said we got to use the Schedule EIC, Earned Income Credit. So if we go to the Schedule EIC, that's going to be the Earned Income Credit for qualifying child information, Schedule EIC. And then, of course, we've got some information with regard to the child. Here's our child name, dependent 1, child information. And, of course, they're going to want information in terms of the qualifications with regards to the rules for the Earned Income Credit, looking something like this. Back to the text. No qualifying child. If you don't meet Rule 8, you don't have a qualifying child. Read Chapter 3 to find out if you can get the earned income credit without a qualifying child. So note that if we don't have the qualifying child, we could still possibly get the earned income credit, although even if we do get it, it's going to have a lower AGI limitation to get it, and we're not going to get as much, of course, in terms of the earned income credit back amount. Back to the text. If your child meets the test to be your qualifying child, but also meets the test to meet the qualifying child of another person, only one of you can actually treat the child as a qualifying child to claim the EIC or earned income credit. If the other person can claim the child under the tiebreaker rules, you can't claim the earned income credit as a taxpayer with a qualifying child unless you have another qualifying child. However, you may be able to claim the earned income credit without a qualifying child. So in other words, obviously if we have 2 individuals that could be a qualifying child for 2 separate tax returns, Again, you can imagine the tax return here, and they're saying, okay, here's the qualifying child, here's the social security number. That social security number, if it's on two different returns, the IRS will basically automatically question that. They're going to say, well, you can't have two qualifying child. So if it is possible for two people, maybe it could be plausible for two people to meet the rules to have this one dependent as a qualifying child. And if you put it on, if two people claim it, then you're not good. Now, if there's two people that are qualified, then you got to go into the tiebreaker rules and see who can take the child for the tiebreaker rules in terms of who would be able to report the child. And then, of course, that individual would report and the other should not. That would mean that the other person can't report the earned income credit with a qualifying child unless, of course, they had more than one child. And then the other child would possibly qualify for the... So in other words, if there's a divorce or something, there's two children or something like that, then it could be possible that there's a separate qualifying child. And it could be possible if you can't claim the one qualifying child, then you still have another one, then of course that could still qualify you for the earned income credit with the second qualifying child. In this presentation, we will discuss special instructions for the Earned Income Credit worksheet related to the Earned Income Credit. We'll be using this information coming from publication 596. Special Instructions EIC Earned Income Credit Worksheet. You will need to decide whether to use the EIC Worksheet A or EIC Worksheet B to figure out the amount of the Earned Income Credit. This section explains how to use these worksheets and how to report the Earned Income Credit on your return. So in other words, there's going to be some special conditions in which case we have to use A or B of the worksheets. Hopefully, it'd be nice if we had some accounting software possibly that could help us to make that decision for us as we enter the data into the software. But note these publications will give us information if we're going to fill these out by hand, whether we use worksheet A or B in this case. Back to the text. EIC Earned Income Credit Worksheet A. Use the EIC Earned Income Credit Worksheet A if you weren't self-employed at any time during 2018 and aren't a member of the clergy, a church employee who files Schedule SE, or a statutory employee filing Schedule C or CEZ. So these are going to be those kind of special conditions that you would have to use basically a special worksheet. So we're going to use worksheet A as basically the default worksheet unless these conditions apply. EIC worksheet B, use EIC worksheet B if you were self-employed at any time in 2018 or are a member of the clergy, a church employee who files Schedule SE, or a statutory employee filing Schedule C or CEZ. If any of the following situations apply to you, read the paragraph, then complete the EIC worksheet B. So you can see that the worksheet A will be the default worksheet for most of the times unless a more unusual circumstance would happen, and then we would go to worksheet B. The more unusual circumstance that more people would probably fall into would be the one where we have self-employed. If we had self-employed income during the year, then that would probably be one of the factors, or of these factors, the one that would catch the most people and require them not to file worksheet A but worksheet B. Back to the text. Net earnings from self-employment of 400 or more. If your net earnings from self-employment are 400 or more, be sure to correctly fill out Schedule SE, Form 1040, and pay the proper amount of self-employment tax. If you don't, you may not get all of the earned income credit. Let's break that down a bit with our mock 1040. So here's our mock 1040. Here's our test 1040, where we got the head of household. We have the one dependent here, and we're going to say that there's income, W-2 income of $30,000, and then we had Schedule C income. That's where this is coming from. That is being reported on Schedule C, the EZ, Schedule C, EZ in this case. In other words, we're saying we have a business income, Schedule C, business income. So if we scroll down, we've got that 1,000 reported in the Schedule C business income, and that means that we have some type of business, right? We would have to use the Schedule C. Now, the thing is, when we have the Schedule C, the IRS wants to make sure that we also report on the Schedule SE, which is the self-employment income, because we got to pay then not just income tax, but Social Security and Medicare. So this would help us to calculate the Social Security and Medicare. So and that's going to be the 141 in this case. So if we jump back to 1040, then we're going to say, okay, well, doing that means we had to pay tax, not income tax, but other taxes, Social Security and Medicare, of 141 because of this income on the Schedule C, which was brought over from the Schedule C. It's also reported on Schedule 1. So we want to basically make sure that if we have Schedule C income, that we're paying the Social Security and Medicare, so that we can then make sure that we have the qualified income of the $1,000 that will be included in the calculation of the earned income credit. And it might be easier to see even if we don't have the $30,000 of wages. If we took the wages away, we said there's no W-2 wages, and then we just have the $1,000 in this case from the business income from the Schedule C, then we'll still, even though we don't have any tax, no income tax, because we only have $1,000 and we got $18,000 of the standard deduction, we still have to pay the Social Security and Medicare, which is the self-employment tax. So these items are basically included on that, and you can see then the earned income calculation based on just the Schedule C income. So whenever we have Schedule C income, we have to then have the Schedule SE, self-employment tax, which is basically Social Security, and Medicare taxes that we'd have to file, which we would do on W-2 if it wasn't for the fact that we were self-employed. And then that information would then mean that this $1,000 would be qualifying typically for earned income and be part of the calculation for the EIC earned income credit. Back to the text. When to use the optional method for figuring net earnings. Using the optional method for the SE, self-employment, to figure your net earnings from self-employment may qualify you for the earned income credit or give you a larger credit. If your net earnings without using the optional method are less than $5,280, see instructions for Schedule SE for details about optional methods. When both spouses have self-employment income, you must complete parts 1 and 2 of EIC Earned Income Credit Worksheet B if all the following conditions apply to you. 1. You are married filing joint. 2. Both you and your spouse have income from self-employment. So both of you have your own basically business income, self-employment income. 3. You or your spouse file the Schedule SE. That's going to be the self-employment schedule. So remember, that's going to be this schedule here's self-employment, which typically you would have to do when you have your own business, a Schedule C. So 3, you or your spouse file Schedule SE and other spouse doesn't file. So you or your spouse file Schedule SE and the other spouse doesn't file the Schedule SE. So in this case, the second spouse didn't file the Schedule SE and one did. Statutory employees. Statutory employees report wages and expenses on Schedule C or CEZ. They don't file Schedule SE. So if you're in a statutory employee situation, you got kind of a special tax situation. If you are a statutory employee, enter the amount on line 1, Schedule C, in Part 3 when you complete the EIC Worksheet B. In this presentation, we will discuss the earned income credit requirements for a qualifying child. The requirement of your child must meet the relationship, age, residency, and joint return tests. This is from publication 596. We're on Rule 8, which says, your child must meet the relationship, age, residency, and joint return tests. So in other words, your child is a qualifying child if your child meets these 4 tests. So we have to go, we'll list these 4 tests here, which of course are relationship, age, residency, and joint return. And then we'll go into some more specifics about each of these items. So Rule 8, we're talking about the qualifying child now. Once again, your child is a qualifying child if your child meets these 4 tests. We got to have all 4 of them be met. We'll talk about them in general. These are them in general. Then we'll go into each of those 4. The 4 tests are, of course, relationship, age, residency, joint return. The 4 tests are illustrated in Figure A. The paragraph that follows contains more information about each text. We're going to go into each one of those on their own in following presentations. In this presentation, we will discuss the relationship test with regard to a qualifying child and the earned income credit. This information from publication 596. You'll recall we're looking at Rule 8. Your child must meet relationship, age, residency, joint return tests, and we're considering here the relationship test. The relationship test. So the relationship test, to be your qualified child, a child must be your either son, daughter, stepchild, foster child, or descendant of any of them, for example, grandchild, or brother, sister, half-brother, half-sister, stepbrother, stepchild, or a descendant of either of them, for example, niece or nephew. The following definitions clarify the relationship test. Let's run a few tests in the tax software. So we have our sample 1040, our test 1040. We have the head of household here with our one individual, and we have the qualifying child. Currently, we have the son here as the relationship of the child. If we go down, we're saying 20,000 of income. We have the 18,000 standard deduction, 2,000 of the taxable income, tax of 201 being wiped out by the child tax credit. And then we have, and again, we're not really focused on the calculation right here of the earned income credit, but we're just going to make some changes now to the relationship test. Also note we have the schedule EIC, which is earned income credit schedule, which of course lists the child here as well. Now, if we test some different type of child settings here, if we go to the dependents and say, okay, what if the child was not a son, but say, if we scroll back up, we say adopted child. Well, we would think that would be good, right? Adopted child, you would think that would still be good to go. We go up top, adopted child in the relationship here, and we still have the credit amount calculated. Now, what if they were your aunt? You know, that would be a little bit unusual for that to be the case. That'd be an unusual family situation there, most likely. But if that was the case, then we go back up top. The software at least is telling us, well, it's kicked us out of it being a qualified child now over here, so we don't see, and the credit has now disappeared. So it's just testing the software as we enter some different individuals in here. How about we select brother? So we have brother. If we go back up top, we're going to say, all right, brother. If we go back in, now we're back in the child tax credit here and brother, the relationship, and we go back, the software seems to be calculating being okay with brother. Now, if we select father, that seems like an unusual situation here. So, but in any case, we've got the relationship test, of course, then we don't have the child tax credit there for that, even if for whatever reason the age tests and whatnot were okay. Foster child. So if we select a foster child, we'll say, okay, now in the relationship foster child, and we should be okay there. The software is still calculating the credit on foster child. How about grandchild? So if we say grandchild for the software, and no, this doesn't verify exclusively everything on the tax code, but the software can help us to kind of give us some guidance because obviously the software is written based on the tax code. So grandchild here, we're saying grandchild, it's still calculating an earned income credit with grandchild. What if we just say other? So other, is that good enough to calculate this? If we put other in the relationship test, then it says other in the relationship, and it's going to say, no, we need to specify something that's within some of those categories that are listed. So here's our list again. And again, just going to the tax software, the tax software doesn't mean that for sure that's the way something is, but you could use tax software in that way to kind of test these items as you go through the publications and whatnot to see if it makes sense. Because, again, the tax software is, of course, based on the information from the tax code. So foster child. For the EIC, earned income credit, a person is your foster child if the child is placed with you by an authorized placement agency or by judgment, decree, or other order of any court of competent jurisdiction. An authorized placement agency includes a state or local government agency, a tax-exempt organization licensed by the state, and an Indian tribal government or an organization authorized by an Indian tribal government to place Indian children. Example, Debbie, who is 12 years old, was placed in your care 2 years ago by an authorized agency responsible for placing children in foster homes. Debbie's your foster child, and therefore would qualify for the earned income credit or qualify as a qualifying child related to the qualifications for the earned income credit. In this presentation, we will discuss Schedule EIC, Schedule Earned Income Credit related to the Earned Income Credit from Publication 596. Schedule EIC. You must complete Schedule EIC and attach it to your tax return if you have a qualifying child. So if we have a qualifying child, we need this Schedule EIC. Back to the text, and are claiming the earned income credit. So Schedule EIC provides the IRS with information about your qualifying child, including their names, ages, social security number, SSN, relationship to you, and the amount of time they lived with you during the year. An example of a file An example of a filled-in Schedule EIC is shown in Chapter 6. Okay, so we have basically an example here. If we look at the example, we're going to say here's our mock return. And on the test 1040 page 1, we just called the name dependent 1. But here's the social security number daughter. And we're going to say, well, if that is going to be used to calculate and give us an earned income credit here, as it is in this example, we're going to need a Schedule EIC. So if we go to Schedule EIC, we have the earned income credit qualifying child information. And of course, what do they want from the qualifying child information? They want to identify the child, make sure that they're reported one time with you, check the verification number. So we're going to need the name then if they want the name. They want the social security number of the child because they want to see if it's a real child, of course, and whether or not that child has been claimed by multiple returns. You know, might want to make sure have the rules for it. Child's year of birth, so they want the year of birth because that's going to be important, of course, to the qualifications as well. And relationship test, which of course we've talked about. This is just information that you can see that they would need to basically verify based on what we've been looking over, how long they've lived with you. And of course, again, we can see that would be relevant to how long they've lived. As you put this information in, if they question any of this, like if they question how long they've lived with you or something, then they could send a letter and basically which is kind of like an audit. And you basically would have to then give some kind of proof of something like that, how long they lived there, which might be mailing address things and stuff from a school they're going to or something like that to verify those amounts. Back to the text. If you are required to complete and attach Schedule EIC but don't, it will take longer to process your return and issue your refund. So note that as you fill out the 1040, it's possible to put the dependents up here and you've got most of the information. You got the social security number, the name, and the relationship. So you would think, maybe that's good and I don't need the Schedule EIC. But they're going to want the Schedule EIC. It's got a little bit of added information that's specific to the qualifications of the earned income credit. So even if you just put the information here and then you process the earned income credit down here with the worksheet and you don't add the Schedule EIC, it could delay things. And so you want to make sure to complete that requirement. In this presentation, we will discuss the age test as it relates to a qualified child related to the earned income credit that's coming from publication 596. We're on Rule 8. Rule 8 reading, your child is a qualified child if your child meets 4 tests. The relationship, age, residency, joint return. We're considering here the age test. So we're considering this with regard to the earned income credit, whether we have a qualifying child, whether that is a qualifying child, which means we have to meet these 4 tests. And of course, we here looking at the test of 2, the age test. So age test, your child must be under age 19 at the end of 2018 and younger than you or your spouse if filing joint. So we got to be under the general rule, this part 1, under 19 as of the end of 2018. And younger than you or your spouse. 2, under the age of 24 at the end of 2018, a student, and younger than you or your spouse if filing jointly. And that would be, of course, an unusual situation where we have a qualifying child that is older than us. That would be unusual, but there could be some unusual family situations. So permanently and totally disabled at any time during 2018, regardless of age. Let's consider this with our tax software here. We're going to have our test 1040. We have Adam. We have the head of household. We have our 1 dependent. And we're saying that it does qualify for a qualifying or the child tax credit. And we also have down here that we have the earned income credit being calculated. Again, we're not here really determining what this calculation is. We'll talk about that later. But we see the calculation and we see that we also have the Schedule EIC related to the qualifying child. So this is the form that we need if we have a qualifying child. Now, if we go back over and we say, all right, well, that's clearly under 19 at this point. So let's say if we're talking about 2018 minus 19 years, so that would be 2. Now, of course, it's questionable if we would even qualify as a dependent at that case. If we still qualified as a dependent, you could see that the dependent has moved over from the child tax credit to the credit for other dependents. So that we're not dealing with a child tax credit, but just note that the qualifications between those two may differ. But if we scroll down and we're going to say, all right, the earned income credit is now gone, and we no longer have the earned income credit schedule. So that's because the age limit there. And again, we're not talking about a normal whether they would be there as a dependent or not, because we're just basically concentrated here on the earned income. So even if they were still qualifying as a dependent for whatever reason, then we're saying that the earned income credit wouldn't be accounted for. So if we go back over and we say, all right, well, let's try the 1 day later. Let's go 01, 01, 2000, 01, 01. Now we're going to say, again, we're not going to really talk about the dependence qualifications, but we're just talking about that age limit qualification for the earned income credit. And here we have the earned income credit, these 3,243. So it looks like now we have the schedule EIC coming back. So again, we're just testing out basically age limits for the earned income credit here. Now, what if we went back and we said, all right, well, what if they are older than that then? So let's say that they're over 19. So we'll say 1998. Let's say, and now we got to say, well, they're not going to qualify us anymore. So that schedule is gone, and we see the earned income credit is gone because they're older now. And again, there would be a question as to whether they're dependents at all, but we're really concentrated on the earned income credit. So now we're going to say, well, what if there's a student? So we're going to say they're a student age 19 to 23. So student, we're going to go back and say, then if we have the qualified student and scroll down, then we see the calculation is back and we got the schedule EIC back as well. Now we'll go back and we'll say, okay, they're well over the 19 or 23 age now, and we're going to go back to our normal just to show that if the credit should be gone, so we no longer have this schedule, and even if they qualify as a dependent, which that's not what we're looking at here, we're just considering the age limit related to the earned income credit, we don't have the earned income credit. What if we go back and we say, all right, what if they were they're not a student and they're older than 23 at this point, but what if we say that they're disabled? So we're going to say, okay, disabled. Then if we go back over, we'll see the credit comes back, right? So now we've got back on the books as they're a dependent here, and they're over 19, over 23. We're not saying they're a student or anything. We have the earned income being calculated, earned income credit being calculated by the tax software for that as well. If we go to the schedule EIC, we see here the dependent, and then we've got the qualifications. Was the child under 24? We're going to say no. Was the child permanently or totally disabled? And we're going to say if that's the case, then we'll say yes, and that's another kind of form of qualification. So notice all those kind of qualification requirements, of course, are why we have the earned income credit schedule EIC. Back to the text. Example. Child not under age 19. Your son turned 19 on December 10th. Unless he was permanently and totally disabled or a student, he isn't a qualified child because at the end of the year, he wasn't under 19. So again, it's at the end of the year. So if they hit the 19 on December in this case, then unless some other condition is there, like a student, most likely, hopefully, then it wouldn't qualify. If they're a student, possibly then could. Child not younger than you or your spouse. Your 23-year-old brother, who is a full-time student and unmarried, lives with you and your spouse. He isn't disabled. Both you and your spouse are 21 years old, and you file a joint return. Your brother isn't your qualifying child because he isn't younger than you or your spouse. So this would be an unusual situation, right? We're saying the brother's there at 23, and we're going to report them on our return, which normally would be fine as a qualifying child under 20, hitting the age requirement. If they're a student, then we should still be okay because it says there's a full-time student, so we should still be okay. Remember, that's one of our requirements down here if we see that they're under the age of 24, right? And but they're older than both, that the child or the one we'd be saying was a qualified child is older than the individual's filing, either spouse, and therefore that would be an unusual situation. That's what would be disqualifying. Next example, your child younger than your spouse, but not younger than you. The facts are the same as example 2, except that your spouse is 25 years old, Because your brother is younger than your spouse, he is your qualifying child, even though he isn't younger than you. So note that only one of the two spouses has to be older, not both, than the qualifying child. So the qualifying child could actually be older than one of the spouses and still be good. Student defined. So what is a student then? So now we have the student rule, and that could be a lot of different things. So what qualifies as a student? To qualify as a student, your child must be during some part of each of the 5 calendar months during the calendar year. So notice that 5 calendar months during the calendar year, so 5 out of 12. 1, a full-time student at a school that has a regular teaching staff, course of study, and regular student body at the school, or 2, a student taking a full-time on-farm training course given by a school described in 1, a state, county, or local government. The 5 calendar months need not be consecutive, so they don't have to be in a row. Basically, the 5 months, they could be 5 months out of the 12. A full-time student is a student who is enrolled for the number of hours or courses the school considers to be full-time attendance. So you have to actually contact the school to say, hey, how many credits are basically full-time credits during a particular time period. So they have to be full-time during a particular time period, which is defined typically by the school, by the number of credits they're taking during that time period. School defined. What's the definition of a school then to qualify? A school can be an elementary school, junior or senior high school, college, university, or a technical, trade, or mechanical school. However, on-the-job training courses, correspondence courses, and schools offering courses only through the internet don't count as a school for earned income credit. Vocational high school students who work in co-op jobs in private industry as a part of a school's regular course of classroom and practical training are considered full-time students. Permanently and totally disabled. So now we have that on there. What does that mean to be permanently totally disabled for the purposes of the earned income credit? Your child is permanently and totally disabled if both the following apply. 1, he or she can't engage in any substantial gainful activity because of physical or mental condition. A doctor determines the condition has lasted or can be expected to last continuously for at least a year or can lead to death. Substantial gainful activity. Substantial gainful activity means performing significant duties over a reasonable period of time while working for pay or profit, or work generally done for pay or profit. Full-time work or part-time work done at an employer's convenience in a competitive work situation for at least the minimum wage shows that the child can engage in substantial gainful activity. So gainfully, like as in kind of gainfully employed, I think is the meaning or the gist of that type of term. Substantial gainful activity isn't work done to take care of yourself or your home. It isn't unpaid work on hobbies, institutional therapy, or training, school attendance, clubs, social programs, and similar activities. However, doing this kind of work may show that the child is able to engage in substantial gainful activity. So in other words, work-related activity or the gainful activity, this is my paraphrasing of it. So the work activity is basically the painful or the gainful activity. However, and the hobbies and whatnot are not. However, the fact that there's physical engagement in hobbies and whatnot may indicate that they are able to engage in gainful activity, work-related activity. The fact that the child hasn't worked for some time doesn't by itself prove the child can't engage in substantial gainful activity. In other words, just the lack of not working, it's based on work right here, so obviously the ability to get income and whatnot. So just the fact that no work has been done doesn't necessarily in and of itself mean that it can't engage, that there could be no engagement in substantial gainful activity, work-related activities, how I'm interpreting that. For example, a substantial gainful activity, see publication 524. So if this is an area of concern or an area that we want to look into, publication 524, irs.gov. In this presentation, we will take a look at the residency test related to the qualifying child, related to the earned income tax credit. This is from publication 596. We're looking at the Rule 8. Your child is a qualifying child if your child meets 4 tests. The 4 tests are relationship, age, residency, and joint return. We're currently focusing in on residency. Your child must have lived with you in the United States for more than half of 2018 to meet this test. You can't claim the earned income credit for a child who didn't live with you for more than half of the year, even if you paid most of the child's living expenses. The IRS may ask for the documents to show you lived with each qualifying child. Documents you might want to keep for this purpose include school and child care records, other records that show the address. So note that when the IRS is going to question this kind of question, they typically they're based on residency. That might be easier to prove than basically the income tests, how much income or how much support was been given, in that they can check things like addresses. So if there's an audit or something like that, they may be looking towards addresses to basically verify from crucial areas such as a school, where do they send the mail to. If we test this in something like the software, here's our test 1040. If we just test the amount of months being lived there, we're going to say, all right, here's our mock 1040. We're going to start off. We have the daughter as the dependent here, qualifying for the child tax credit, and we see that we have the earned income credit being calculated. We're not getting into the calculation number at this time. We're just saying it's calculated here, and we have the schedule EIC being calculated, and we can see the dependent. We can see the child's date of birth. And we can also see the 12 months here. So what if we change this 12 months to something other than 12 months, such as, let's say, 7 months, and we go back to the forms. We're going to say, all right, now 7 months is over, what do we say here? It's over half the year, which would be over 6 months. So we're going to say it's still showing then this schedule EIC, and we can see that we still have the dependent being showing up on the software with that one change. Still have the calculation of the earned income credit. Now let's say, well, what if we just put a 6 here instead? That would be exactly half, which might be the case in some agreements, especially in a separation type of agreement. So then we say, oh, gone, right? So now we're going to say we have the dependent at child tax credit still being calculated, where that's not what we're focused in on here, though. We're focused in on the earned income credit, which has disappeared. Anything else, just dismiss. We're just testing the earned income credit and just see what the software would do if we change that one factor. And so the earned income credit's gone, and you can see that the schedule EIC is gone completely, because now they're saying that they're basically not qualified, or that's the presumption that this qualification has removed it with regard to the earned income credit with regard to the software. So let's keep going with our text. The following paragraph clarified the residency test. United States. This means the 50 states and District of Columbia. It doesn't include Puerto Rico or U.S. Possessions such as Guam. Homeless shelter. Your home can be any location where you regularly live. You don't need a traditional home. For example, if your child lived with you for more than half the year in one or more homeless shelters, your child meets the residency test. So whatever we call home for the tax code may not actually be, it may be a place wherever we call home, our primary place where we stay basically would be kind of the residency test, typically my interpretation here. Military personnel stationed outside the United States. U.S. military personnel stationed outside the United States on extended active duty are considered to live within the United States during the duty period for purposes of the earned income credit. So obviously, if they're outside the United States for active military duty, then that would be an exception to the rule typically. Extended activity duty. Extended activity duty means you are called or ordered to duty for an indefinite period or for a period of more than 90 days. Once you begin serving your extended active duty, you are still considered to have been on extended active duty even if you don't serve more than 90 days. Again, exceptions to the rule with military. Birth or death of child. A child who was born or died in 2018 is treated as having lived with you more than half the year if your home was the child's home for more than half the time he or she was alive in 2018. So obviously, if the child was born in 2018, then they're not going to be living under the household per se in the form of a separate physical being in the house, possibly for more than a year, but that's typically going to be an exception. So for example, if we go back to our test 1040 and we say that we have a child here and we're saying that they were born 12/31/2018, the last day of the year, well, then they're still basically usually counted then for as a dependent in that year, basically, and would be counted for the full year for the child tax credit. So we might put lived in the home for 1 year. I think most software actually wants you to put 12 months, even though it's only been 1 month, given the fact that there was only a partial year of life, at that time period. So if we go back to the forms, then we're going to say, all right, there's a child tax credit, or here's the dependent. And again, we're not focusing on child tax credit, but there's kind of a relationship. So we're focusing here. We see the earned income credits being calculated just with that one change to the date. And we see the schedule. So the child dependent, we have the child's date of birth in the year 2018, the end of the year, the last day of the year. We put 1 month here, and we may still be putting 12 months if it was the date or the year of birth. But note the software, even with 1 month, is calculating the credit here. Whereas if it wasn't the first year of life, then and it was only 1 month, like if we go back here and we say this was 2017, and so now they were born the prior year, but we leave this 1 month, now it's gone, right? We don't get that at all, because it wasn't the year of birth, and we only reported 1 month, which isn't over half the year. Back to the text. Temporary absences. Count time that you or your child is away from home on a temporary absence due to a special circumstance as time the child lived with you. Examples of special circumstances include illness, school attendance, business, vacation, military service, and detention in a juvenile facility. So these are all instances that would kind of be exceptions when we're trying to count out the months to be over the 6 months. These would be kind of exceptions for the temporary absences. Kidnapped child. A kidnapped child is treated as living with you for more than half of the year if the child lived with you more than half the part of the year before the date of the kidnapping or following the date of the child's return. So you can see how when the tax code gets built up, how these kind of different scenarios would happen. You're like, well, what happens here? And so the tax code obviously put in something for kidnapping, which would make sense. This kind of treatment would make sense, that they would qualify based on being there for the year. So anyway, moving forward back to text, the child must be presumed to be law enforcement authorities to have been kidnapped by someone who isn't a member of your family or your child's family. The treatment applies for all years until the child is returned. However, the last year this treatment can be applied is the earlier of 1, the year there is a determination that the child is dead, or 2, the year the child would have reached age 18. In this presentation, we will take a look at the joint return test as it relates to a qualifying child for the earned income tax credit. This information can be found in publication 596. We're looking at Rule 8 from the publication. Your child is a qualifying child if your child meets 4 tests. The 4 tests are relationship, age, residency, joint return. Here we're focusing in on joint return test, test number 4. To meet this test, the child can't file a joint return for the year. And that would kind of make sense under normal rules, because if they file a joint return, they would be married, and you would think that would be kind of unusual to qualify as a qualifying child of somebody else's to be married. So normally that wouldn't be an issue, but there could be some exceptions. So exception. An exception to the joint return test applies if the child and his or her spouse file a joint return only to claim a refund of income tax withheld or estimated tax paid. So if there's this exception, if there's just a return just to get back the amount of tax that was paid, and you can see part of the code on this is trying to basically say that they didn't file a return to get an earned income credit, which is more money back than was paid in, but just simply to get back the payment that they made, right, with the W-2. So when they had withholdings for the W-2, they made payments. Now, the earned income credit and the child tax credit can take you beyond those withholdings, and that's what the IRS is obviously very suspicious of, to have these credits be taken beyond that amount, because they can be abused because of the nature of them. So example 2, that's my interpretation, of course, of the explanation on this exception rule here. Example 2, child files a joint return to get refund of tax withheld. So your 18-year-old son and his 17-year-old wife had $800 of wages. So we've got a young couple here, 18 and 17. They had $800 of wages from part-time jobs and no other income. So that's pretty low on the wages. So they might have had some withholdings on that, wages from their income. They don't have a child, neither is required to file a tax return. So they're not required to file the return. Taxes are taken out of their pay. So that's the issue here. So we have the 800 taxes were taken out because it's W-2 pay, taxes were taken out of it, but they don't need to file the tax return generally. But if they want to get that money taken out, they have to file. Taxes were taken out of their pay, so they file a joint return only to get the refund of the taxes. The exception to the joint return test applies, so your son may be your qualifying child if all other tests are met. So that one example 2, child files joint return to claim American Opportunity Credit. The facts are the same as example 1, except no taxes were taken out of your son's pay. He and his wife aren't required to file a tax return, but they file a joint return to claim an American Opportunity Credit of $124 and get a refund amount. So now you could see the IRS might be suspicious of this now because, right, no taxes were paid, and yet there could be a credit being paid out above and beyond any taxes that were paid in this scenario. So now that might be a problem for qualify to have them be also as a qualifying child. Because claiming the American Opportunity Credit is their reason for filing the return, they aren't filing it only to claim a refund of income withheld. So they're not just trying to get the money back that was taken from their paycheck as they worked. They're looking to get the money over and above a credit that's different. That's not related just to that getting that money back that they were given. In other words, they're not trying to say, hey, I just don't want to pay any tax because I don't owe any tax, but actually lowering the tax liability or possibly getting money back above and beyond any type of tax liability. So the exception to the joint return test doesn't apply, so your son isn't your qualifying child. Okay, married child. Even if your child doesn't file a joint return, if your child was married at the end of a year, he or she can't be your qualifying child unless, 1, you can claim the child as a dependent, or 2, and again, you'd have to look for the dependent rules on that, which will address kind of the joint returns typically as well. And 2, the reason you can't claim the child as a dependent is that you let the child other parent claim the child as a dependent under the special rule of divorce or separated parents described later. So if that's going to be applicable, we have that special rule. In this presentation, we will take a look at an Earned Income Credit Eligibility Checklist. This information can be found in publication 596. So this is going to be our checklist. This is going to be kind of a recap of the information we've looked at so far, and to go through it in kind of a checklist format might be a good way to format this information so you can go through basically the checklist in a quicker fashion as you look through this information. So you may claim the Earned Income Credit if you answer yes to all of the following questions. So we got the yes/no questions over here. We're going to have the checklist related to the Earned Income Credit. Number 1 is your AGI. That's going to be the adjusted gross income, remember. So if we go to the adjusted gross income, we're talking about line 7, adjusted gross income. So is your AGI, adjusted gross income, less than $15,270 or $20,950 for married filing joint? So married filing joint, of course, would have the higher AGI limit to see if you can take the credit or not. Otherwise, the lower limit, $15,275, if you don't have a qualifying child, right? So now we're going, if you have one qualifying child, then the income AGI limit goes up, $40,320 or $46,10 for married filing joint. 2 qualifying childs, the AGI goes up, $51,492 married, $45,802 for others other than married. And then if you have more than 2 qualifying child, then we're at $54,884 for married, $49,194. So if your AGI is less, then we would say yes, and we can then move forward to number 2, which is, do you and your spouse have a valid Social Security number that you got by the due date of your 2018 return, including extensions? If we're going to say yes, then we move forward. Number 3, if your filing status, married filing jointly, head of household, qualified widowers, or single, and so notice the filing statuses that we're talking about here, it names all of them basically except married filing separately, the one that's not included. So because our goal here is to have everything say yes. So this is your following steps being required. It's not listing the one that but just cannot file to claim the earned income credit, which is married filing separate. Caution, if you or your spouse is a non-resident alien, answer yes only if your filing status is married filing jointly. 4, answer yes if you aren't filing Form 2555 or Form 255EZ. That's the foreign income form. Otherwise, no. So we're going to say yes here. And then typically, we're hoping for all these basically to be yes to see if we could check this off. Number 5, is your investment income $3,500 or less? Interest, dividend income, main type of investments, possibly capital gain information. So again, probably if that's the case, we're going to say yes. Go forward. Number 6, is your total earnings, is your total earned income at least $1 but less than? So notice what this requirement is doing again. It's saying that your earned income, meaning like wages are the most common type of earned income, a little bit different than the AGI limitation. It's got to be over 1 because it has to have, if you have no earned income, you're not going to get an earned income credit. But it's got to be under the caps, which again are similar to the caps we had up top. So now we're not talking about the AGI limits, we're talking about earned income. So AGI could have been like the investment income. Now we're thinking about the earned income because that's what the actual earned income credit is going to be calculated on. So it's got to be over, you have to have actually earned income that's over $1 and under these caps that, well, I won't go through all the caps again, but these caps, whether you have a qualifying child, 1 qualifying child, 2 qualifying child, or more. So starting off, if you don't have a qualifying child, 1, 2, or more. So we have to have at least $1. If we only have $1 of earned income, we're not going to get much earned income credit. But it has to be between $1 of earned income and then below the caps. If that's true, then we're going to say yes there. Moving on to number 7. Answer yes if A, you aren't a qualifying child of another taxpayer, or B, you are filing a joint return. Otherwise, answer no. So we're saying answer yes if you aren't a qualifying child of another taxpayer. In other words, you remember this rule, we can't really be a qualifying child, of course, of someone else in order to basically claim the child tax credit typically. So hopefully we're not, I mean, if we're not a qualifying child, we'll say if yes, if you aren't a qualifying child. And then it says stop. If you have a qualifying child, answer question 8 and 9 and skip 10 to 12. If you don't have a qualifying child, or if another person is entitled to treat your child as a qualifying child under the tiebreaker rules explained in Rule 9, skip question 8 and 9 and go to 10 and 12. So now we have that fork in the road again between the people who have a qualifying child and those that don't. So these are where the questions hit that fork in the road. Number 8, does your child meet the relationship, age, residency, and joint return test for a qualifying child and have a valid SSN, Social Security number, that he or she got by the due date of your 2018 return? If that's yes, then we're going to move forward. Number 9, is your child a qualifying child only for you? So meaning we don't have a qualifying child for multiple. Answer yes if A, your qualifying child doesn't meet the test to meet a qualifying child of any other person, or B, your qualifying child meets the test to be a qualifying child of another person, but you are the person entitled to treat the child as a qualifying child under the tiebreaker rules. In other words, it's got to be your qualifying child, one way or the other. Either they only qualify for you, or they're qualifying under the tiebreaker rules. So we're going to say yes there. Number 10, were you or your spouse, if filing a joint return? So these are the requirements. Remember the split. If you don't have a qualifying child, because we were going to skip to 10. So were you or your spouse, if filing joint, at least 25 but under 65 at the end of 2018? Again, if that's our case, we're hoping to say yes. And then again, this applies if we follow this guideline based on these guidelines. And then 11, answer yes if A, you can't be claimed as a dependent on anyone else's return, or B, you are filing a joint return. So again, here we have the dependent kind of rule. So we can't be a dependent of someone else and then file for the child tax credit. 12, Was your main home and your spouse's if filing joint return in the United States for more than half the year? So there we have that kind of where you hear more than half the year, United States more than half the year. So that's going to be our question here. Persons with a qualifying child, if you answer yes to questions 1 through 9, you can claim the earned income credit. If you have more than one child, you can claim the earned income credit as long as you answer yes to questions 1 through 7 and can answer yes to question 8 and 9 for at least one child. Remember to fill out Schedule EIC, the Earned Income Credit Schedule, and attach it to your Form 1040. If you answer yes to questions 1 through 7 and no to question 8, answer question 10 through 12 to see if you can claim the Earned Income Credit without a qualifying child. Persons without a qualifying child, if you answer yes to questions 1 through 7 and 10 and 12, that's where that break was, 10 and 12 here, you can claim the Earned Income Credit. If you answer no to any questions that apply to you, you can't claim the Earned Income Credit. In this presentation, we will discuss the rules related to the Earned Income Credit. Specifically, the qualifying child cannot be used by more than one person to claim the Earned Income Credit. This is coming from publication 596. We're on Rule 9. Your qualifying child cannot be used by more than one person to claim the Earned Income Credit. And this would kind of make sense intuitively because we would think that the one individual, one person, the IRS only wants to see basically one social security number per person in one tax return. So if we have two people that there's a qualifying child, then of course there's a problem and typically something has to be dealt with in terms of who's going to have the qualifying child. So we want to be careful of that. Watch out for that. Back to the text. Sometimes a child meets the test to be a qualifying child for more than one person. However, only one of these persons can actually treat the child as a qualifying child. So note that it is possible if you look at the regulations, you're saying, well, hey, there's a qualifying child for me and for this other person. Well, what do I do there? Well, basically the thing is, well, now you have to have some type of tiebreaker so that you don't have the qualifying child reported twice. So that's basically the IRS's position. Back to the text. Only that person can use the child as a qualifying child to take all the following tax benefits, provided the person is eligible for each benefit. So here's the benefits we're talking about. Number 1, the child tax credit, credit for other dependents, and additional child tax credit. Number 2, head of household filing status. Number 3, the credit for child and dependent care expenses. Number 4, the exclusion for dependent care benefits. And number 5, the earned income credit. So we, of course, here are concentrating on the earned income credit. But note that as we think of a child on one return or the other, they can influence all of these different things. So in that way, they're all kind of interwoven together when we're considering one child. They could be somewhere or another. Now, obviously, they can have different effects on something like a head of household status and whatnot. It could depend if there's another child involved and many other types of factors that could be involved. But these are the things, or the main type of things, or some of the things that can be influenced by a child being on one return versus another return. Back to the text. The other person can't take any of these benefits based on this qualifying child. So that doesn't mean that they can't take any of those benefits necessarily, or they still don't qualify for something within them, but they can't do it based on the qualifying child if the qualifying child, of course, is not being reported on that return, that being one of the requirements typically for many of those things we just looked at. Back to the text. In other words, you and the other person can't agree to divide this tax benefits between you. So note what that's saying. It's basically saying, hey, look, there's all these things going on here that could be related to the child. It's not like you can say, we can't basically break these benefits up if they're all reliant on the child. We can't basically say, hey, it would be best for taxes overall if we report the child for this benefit over here and that benefit over there, and that would have the best tax effect. You can see how messy that would be from the tax return standpoint, because then we would have the two social security numbers on two different returns, and we'd have to verify that the benefit was only used for this purpose here and that purpose there. So that's basically one of the reasons, or my interpretation of one of the reasons, that the IRS basically says, hey, one person's going to basically get all the benefits of the individual child that could include these 5 items as part of those, and the other will not, based on who the return is going to. That's basically the general rule of it. Back to the text. The other person can't take any of these tax benefits unless he or she has a different qualifying child. So note that there could be something else happening, another child involved, in which case, we could solve some of the difficulties. So if there's two qualifying child, then the head of household status, for example, might be met by just simply having another child, and the one child that is not the one that's dependent on in order to qualify for that standing. Back to the text. The tiebreaker rules which follow explain who, if anyone, can claim the EIC earned income credit when more than one person has the same qualifying child. So now we're going to say, all right, well, what do we do when the child is there with two people that it could be a qualifying child for either one? Well, now you need a tiebreaker type of rule. Back to the text. However, the tiebreaker rules don't apply if the other person is your spouse and you file a joint return. Tiebreaker rules to determine which person can treat the child as a qualifying child to claim the 6 tax benefits just listed. The following tiebreaker rules apply. So note that these are the tiebreaker rules. So now we're saying, okay, if we had the qualifying child meets all the tests, but now they are qualified for 2 people, and so now we need a tiebreaker to see who would basically be able to claim the benefits for the qualifying child. Here we go. If only one of the persons is the child's parent, the child is treated as the qualifying child of the parent. So if the qualifying child is qualifying for a parent and something other than a parent, like a grandparent or something, then the parent would typically win in that case, the tiebreaker rule. Next one, if the parents file a joint return together and can claim the child as a qualifying child, the child is treated as a qualifying child of the parents. So again, the parents typically would have the priority. Next item, if the parents don't file a joint return together, but both parents claim the child as a qualifying child, the IRS will treat the child as the qualifying child of the parent with whom the child lived for the longer period of time. And that's typically going to be one of the major tiebreaker rules you'll kind of see coming up. Where did the child live at? They're not really looking at the income so much as the living. Where did the child live at? That's usually going to be one of the major tiebreaker types of rules. Back to the text. If the child lived with each parent for the same amount of time, the IRS will treat the child as a qualifying child of the parent who had the higher AGI or adjusted gross income for the year. So what if it was split evenly, 50-50 child between the two? Well, then you're looking at the higher adjusted gross income. And again, the justification there would be for the IRS saying, well, if they have the higher AGI, then maybe they took the financial care of it or something like that would be the rationale, I would assume. Again, that's my interpretation. Back to the text. If no parent can claim the child as a qualifying child, the child is treated as the qualifying child to the person who had the highest AGI adjusted gross income. So it's possible the child possibly doesn't meet the qualifying child test for anybody, and the IRS doesn't say, well, nobody gets the benefits. That's not, the child needs to be reported somewhere. The IRS actually wants the Social Security number most likely. So they're going to go with the one that's going to have the higher AGI in that case. So again, they're going back to the default of the income limitation. Back to the text. If a parent can claim the child as a qualifying child, but no parent does so claim the child is treated as a qualifying child of the person who had the higher AGI, adjusted gross income, for the year, but only if that person's AGI is higher than the highest AGI of any of the child's parents who can claim the child. So again, that's kind of an unusual type of rule depending on the parents versus the AGI of the other individual if no one claimed the child. So it's an unusual circumstance. Back to the text. If your qualifying child is treated under the tiebreaker rules as the qualifying child of another person for 2018, you may be able to take the earned income credit using the rules in Chapter 3 for taxpayers who don't have a qualifying child. So again, if they don't, bottom line is if the qualifying child doesn't qualify for you, it doesn't necessarily mean you don't get the earned income tax credit. You may still get it, but not based on that qualifying child, and maybe no qualifying child, in which case the earned income credit would be much lower, but possible to still get some earned income credit. Subject to these tiebreaker rules, you and the other person may be able to choose which of you claim the child as a qualifying child. See examples 1 through 12. Back to the text. If you can't claim the earned income credit because your qualifying child is treated under the tiebreaker rules as the qualifying child of another person for 2018, you may be able to take the EIC earned income credit using a different qualifying child, or take the earned income credit using the rules in Chapter 3 for people who don't have a qualifying child. So just because one child doesn't qualify doesn't mean that you don't have another child that might qualify you for some earned income credit, although the amount will probably be less, or qualify without a child, which means the amount of the earned income credit will most likely be less. Back to the text. If the other person cannot claim the earned income credit, if you and someone else have the same qualifying child, but the other person can't claim the earned income credit because he or she isn't eligible, or his or her earned income or AGI is too high, so the earned income credit is too high to claim the earned income credit for them, you may be able to treat the child as a qualifying child. See examples 6 and 7, but you can't treat the child as a qualifying child to claim the earned income credit if the other person uses the child to claim any of the other 5 tax benefits listed earlier in this chapter. So note what's happening here. We're saying, well, it's too high to claim the earned income credit for one individual, so it would be more beneficial than you would think from a tax standpoint for the other person to claim the child. But again, you can't split up those basic benefits that could happen between one and the other, and so that's going to be one of the restrictions. So examples. The following examples may help you in determining whether you can claim the earned income credit when you and someone else has the same qualifying child. Example number 1. Child lived with the parent and grandparent. You and your 2-year-old son, Jimmy, lived with your mother all year. You are 25 years old, unmarried, and your AGI is 9,000. Your only income was 9,000 from a part-time job. Your mother's only income was 20,000 from her job, and her AGI is 20,000. Jimmy's fathers did not live with you or Jimmy. The special rule explained later for divorced and separate parents or parents who live apart doesn't apply, so we're not talking to any special divorce agreement here. Jimmy is a qualifying child of both you and your mother. So note that it's basically the way they set this up here. The qualifying child is qualifying under the rules between two individuals, mother and the mother of the child and the mother of the mother, because he meets the relationship, age, residency, and joint return test for both you and your mother. So it meets all the tests. However, only one of you can treat the qualifying child to claim the earned income credit and the other tax benefits listed earlier in the chapter for which this person qualifies. So you can see the situation here. So now we've got the situation, the child could possibly qualify on 2 returns, but obviously only one can claim for the qualifying child. And you might start thinking, well, you know, look at the difference between the AGI limitations. What's that going to impact on the earned income credit? So what, you know, you could start thinking, well, what's the difference between the earned income credit for someone who has 9,000 versus 20,000 of income and whatnot? Back to the text. He isn't a qualifying child of anyone else, including his father. If you don't claim Jimmy as a qualifying child for the earned income credit or any of the other tax benefits listed earlier, your mother can treat him as a qualifying child to claim the earned income credit. So note what they're saying here is, you know, typically you would think the mother would claim the earned income credit with the 9,000 of AGI. But note that the 9,000 of AGI is pretty low. So if you claimed it as 9,000, I mean, you don't even know any taxes at 9,000 of AGI. If the mother just said, I'm not going to claim as the child, then it would basically kind of possibly default to the mother who has a 20,000 AGI. And you can imagine a situation where this might be applicable. So if you had our test 1040 here, we're going to keep the name here, but let's say we had someone who was a head of household status. They had 2 dependents here, 2 dependents, 2 children, and we're saying that the earned income is the 9,000. So only 9,000 of earned income with the 2 children. And we're going to say, well, there's no tax that's going to be paid because the standard deduction is greater than that 9,000. But they might get still money back because of the earned income credit and the child tax credit. So here's the earned income credit. We're just letting the software calculate it here based on the information that we've put in there. And we can imagine a situation and say, all right, well, there's the 3,610 with these 2 children. What if it's the case? What if one of these children is not reported on the return, just to test it out and see what happens on the software? We'd say, all right, well, if we go back, we're going to say that one of the child is not reported for the taxpayer. We're going to say that that'll be the second child, and we'll say that's not going to be reported. So now we're going to say that the mother here, or, this tax return, we have Adam. Adam's the mother. But here we have now the daughter's the tax preparer. And so now there's the 9,000, still doesn't owe any tax. And now we can see the change to the tax credit of the 3,069 here. But it's not a huge change, right? And you could think of then, well, what would happen on the other side? Well, what if the mother then was able to then pick up the tax credit, right? We can imagine this being the starting point. And again, I'm just using the same name. So this family is all named Adam Smith. So this is the mother now. So she single, starting with a single filing status, no dependents. And we got the 20,000 of income. Standard deduction is only 12,000 now because it's single rather than head of household. And we've got the 8,000, and that would be just 803 that would be owed. So actually paying taxes on the 803. What would happen if she got a dependent, basically was able to claim the dependent in a qualifying child? Well, then it might change the filing status from single to head of household, possible, which could be big. And then you'd have the dependent here. And the child tax credit's not what we're focusing in on here, but you do have questions about the child tax credit. We're looking at the earned income credit at the moment, but those two are both kind of big things they could be you want to look into with regard to the dependents. And then we've got the wages here, and now this has increased to 18,000 from 12,000, which brings the taxable income down to 2,000. So the tax is only 201. And then if the child tax credit applies, then you can consider the child tax credit and whatnot. But we're just looking at the earned income credit being calculated just based on this scenario, and this is what the software has on the earned income credit. So this is going to be basically the earned income credit, and then the child tax credit. You'd have to consider that. We'll talk more about that in other presentations. But just note that you can see a scenario where it might be beneficial in that case, where you'd say, well, it would be better to have the child be claimed possibly as the mother on the mother's return for tax purposes than on the daughter's return. Back to the text example 2. Parent has higher AGI than grandparent. The facts are the same as example 1, except your AGI is 25,000. Because your mother's AGI isn't higher than yours, she can't claim Jimmy as a qualifying child. So basically, I'm not sure exactly why they put that in the rule, but in this case now they're saying it's all the same, except now the mother has you have a higher AGI than your mother, and in that case then the higher AGI has to basically take the credit, so you couldn't go through that scenario and transfer. But example 3, 2 persons claim the same child. The facts are the same in example 1, except that you and your mother both claim Jimmy as a qualifying child. So now we have a scenario where both returns, we have 2 returns filed the same social security number. That's a problem. And the IRS will very likely kick that back out because they don't need to audit anything randomly. The system will say, hey, there's 2 social security numbers on 2 separate tax returns. That shouldn't happen. It's automatic. The system will find it and probably kick that out. So if you do that, you're pretty confident you're probably going to get a letter on that and questioning what's going on there. So, and then you don't want to do that intentionally and all that kind of stuff, of course, too, because then intent is an issue. So whether it be a mistake or intentional, if 2 people have the same social security number, 2 separate tax returns, the IRS is very likely to kick that back out and just automatically have a letter on it. So in any case, back to the text. In this case, you as your child's parent will be the only one allowed to claim Jimmy as a qualifying child for the earned income credit and the other tax benefits listed earlier in which you qualify. So you can see that that's the case, right? They're saying if the mother filed the tax return and claimed the child, then the default goes to the filing of the mother that filed. And then if they did not file, that's the kind of unusual situation where it could then default and go to someone else, the other qualifying person. But so you want to basically use that to your benefit in a situation where that might benefit when you purposely don't file and have it default otherwise. Then, of course, if you do file, then it would be going to the mother typically in this situation. Okay, back to the text. The IRS will disallow your mother's claims to the earned income credit and any of the other tax benefits listed earlier based on Jimmy. Your mother can't take the earned income credit for the taxpayer without a qualifying child because her AGI is more than 15,270. So they're going to say, hey, we're going to remove the child, which means you're not going to get an earned income credit because her income is too high to get an earned income credit based on no child, having no child. So of course the earned income credit would, even if her income was around 15, the income credit would be a lot less than it would with a child. Example 4, qualifying children split between 2 persons. The facts are the same in example 1, except that you also have 2 other young children who are qualifying children of both you and your mother. Only one of you can claim each child. However, if your mother's AGI is higher than yours, you can allow your mother to claim one or more of the children. For example, if you claim one child, your mother can claim the other. And that's kind of what we were looking at. You can imagine a situation where that would be beneficial. You can imagine a situation where the mother's spending all of her time taking care of the kids, and therefore her income is relatively low, whereas the grandmother of the children it might be working more. And in that case, then it would make sense that you would want it, just from a tax lower in the tax bill overall, that you would want the child to be on the one with the higher AGI. Might get more of a benefit. So you can imagine that situation, and it's possible to think of a situation where you purposely don't report, or you allow the mother to claim by not claiming on the one return. Example 5, taxpayer who is a qualifying child. The facts are the same in example 1, except that you are only 18 years old. This means you are a qualifying child of your mother. So now that's an age problem. Qualifying child of the mother, which usually disqualifies. Okay, continue with the text. Because Rule 10 discussed next, you can't claim the earned income credit and can't claim your son as a qualifying child. Only your mother may be able to treat Jimmy as a qualifying child to claim the earned income credit. If your mother meets all the other requirements for claiming the earned income credit and you don't claim Jimmy as a qualifying child for any of the other tax benefits earlier, your mother can claim both you and Jimmy as qualifying children for the earned income credit. So now we've got this issue of when we were saying that you can't be allowed to be claimed by someone else as a qualifying child, and that means that basically it's going to default to the mother or the grandmother of the child for the qualifying child. Example 6, grandparent with too much earned income to claim the earned income credit. So what if the grandparent is able to have the child, but the earned income credit, of course, goes away if her income is too high to take any earned income credit. The facts are the same as the example in 1, except that your mother earned $50,000 from her job. Because your mother earned income too high for her to claim the earned income credit, only you can claim the earned income credit under your son, using your son, right? The mother's income's too high to claim. Example 7, parent with too much earned income to claim the earned income credit. The facts are the same in example 1, except that you earned $50,000 from your job and your mother earned $50,500. Your earned income is too high for you to claim the earned income credit, but your mother can't claim the earned credit either because her AGI is higher than yours. So remember, now we've got the limitation on the cap of the earnings to claim the earned income credit. And obviously, if your income gets over a certain level, you don't get the earned income credit because that kind of defeats the point of it. Example 8, separated parents. You, your husband, and your 10-year-old son, Joey, lived together until August 1st, 2018, when your husband moved out of the household. On August and September, Joey lived with you. For the rest of the year, Joey lived with your husband, who is Joey's father. Joey is a qualified child of both you and your husband because he lived with each of you for more than half the year and because he met the relationship age and joint return test for both of you. At the end of the year, you and your husband still weren't divorced, legally separated, or separated under the written separation agreement. So the special rule for divorced or separate or parents who live apart doesn't apply. So we're not talking about the special rule for divorce or living apart. Continuing on, you and your husband will file separate returns. Your husband agrees to let you treat Joey as a qualifying child. This means if your husband doesn't claim Joey as a qualifying child for any of the tax benefits listed earlier, you can claim him as a qualifying child for any tax benefit listed earlier for which you qualify. However, your filing status, married filing separately, so you can't claim the earned income credit or the credit for child dependent care expenses. So you can see this is kind of an unusual situation where you have a separation, but it's not legally divorced. And if the problem is that typically you can only file the tax return if you're legally married, you really only have married or married filing separately, unless you become separated legally where you can have single or head of household filing status. And so if you file married filing separately, the problem is there's a direct rule that says you can't claim the earned income credit if you're filing married filing separately. You have to file single or head of household, which you may not qualify for under this kind of condition. So see Rule 3. So it's clearly under that situation, if you're dealing with the earned income credit, obviously then it's best to either be married or separated, and not have a situation where you have to file married filing joint, because that's going to cause problems with the earned income credit. Example 9, and that's probably good for many different situations. The married filing separate disallows some kind of credits a lot of times, so it's often not beneficial to do that. Example 9. Separated parents claim same child. The facts are the same as example 8, except that you and your husband both claim Joey as a qualifying child. In this case, only your husband will be allowed to treat Joey as a qualifying child. This is because during 2018, Boy lived with him longer than with you. So notice it defaults to who did the child live with longer. That's kind of like the first rule, the first test on that. So you can't claim the earned in. So obviously if 2 returns were filed with the same social security number for the same child, then who gets the claim? Typically the one the child lived with longer. So if that's a question, you might want to log down, the days if you have to. So, okay, so you can't claim the earned income credit either with or without a qualifying child because your filing status is married filing separately. However, your husband's filing status is also married filing separately, so he can't claim the earned income credit or the credit for child and dependent care expenses. So again, that married filing separately is something you kind of want to avoid if you're dealing with these kind of credits. You either want to file joint or file have the legal separation, so you can file head of household or single typically. Example 10, unmarried parents. You, your 5-year-old son, and your son's father live together all year. You and your son's father aren't married. Your son is a qualifying child of both you and his father because he meets the relationship age residency joint return tests for both you and your father and his father. Your earned income, AGI, is $12,000 and your father's earned income is $14,000. Neither of you had any other income. Your son's father agrees to let you treat the child as a qualifying child. This means if your son's father doesn't claim your son as a qualifying child for the earned income credit or any of the other tax benefits listed earlier, you can claim him as a qualifying child for the earned income credit and any of the other tax benefits listed. So note that we have this qualification for both. There's no marriage, so we don't have to file. There's no married filing separate return or married return necessary here. The child qualifies for both, so now there's a question of, obviously only one can basically claim the child, and in this case they're basically saying there's an agreement of one to claim and not the other. And so example 11, unmarried parents claim the same child. So here's the example if there's no kind of agreement on it. And notice it, from the IRS standpoint, obviously if you have 2 separate returns, one claims the social security number, the other doesn't, the IRS is probably thinking, their system, their computers going, oh, well that makes sense at least, right? We don't have 2 social security numbers, or we don't have a missing social security number or anything like that, so that's probably going to be okay. Now here's the thing that's not going to be okay, clearly, because the computer system once again is just going to be saying, hey, I've got 2 different returns with 2 social security numbers that are the same on 2 returns. That doesn't make sense. It's going to be kicked out automatically. It's just going to pick that up pretty easily typically. So this is the situation where there's going to be a problem. You're going to get notifications and then you deal with them from there. If you have to deal with them, you deal with them. But just note that it's going to be picked up typically. So here, back to the text. The facts are the same, example 10, except that you and your son's father both claim your son as a qualifying child. So that's going to be an issue. And again, don't let the fact that it's an issue mean that you shouldn't report if it's right for you to report that situation. Just note that you'll have to most likely deal with a letter and then process further in accordance with the rules here. So in this case, only your son's father will be allowed to treat your son as a qualifying child. This is because his AGI is 14,000 is more than your AGI of 12,000. So note, if all the other tests are met and the living is basically the same, because that's usually the default, then it goes to the AGI. So usually it goes to who the son or daughter lived with more, and then it reverts to the AGI. So that's that. So then you can claim the earned income credit without the qualifying child. So it's note, you can still claim the earned income credit, but without a qualifying child, which means, of course, it'll be a lot lower than it would with a qualifying child. Example 12, child did not live with a parent. You and your 7-year-old niece, your sister's child, lived with your mother all year. You are 25 years old and your AGI is 9,300. Your only income was from a part-time job. Your mother's AGI is 15,000. Her only income was from her job. Her niece's parents filed jointly, have an AGI of 9,000, and didn't file with you or their child. Your niece is a qualifying child of both you and your mother because she meets the relationship age, residency, and joint return test for both you and your mother. However, only your mother can treat her as a qualifying child. This is because your mother's AGI, 15,000, is more than your AGI of 9,300. So another kind of default example to the AGI limitation in special cases. Special rule for divorce or separated parents or parents who lived apart. A child will be treated as a qualifying child as his or her non-custodial parent for purposes of claiming the child tax credit, but not for the earned income credit if all the following statements are true. So, number 1, the parents are divorced or legally separated under the decree of divorce or separated maintenance. B, are separated under a written separation agreement or lived apart at all time during the 6 months of 2018, whether or not they are or were married. 2, the child received over half his or her support for the year from the parents. And 3, the child is the custody of one or both parents for more than half of 2018. 4, either of the following statements is true. A, the custodial parent signs 8332 or a substantially similar statement that he or she will not claim the child as a dependent for the year, and the non-custodial parent, so this is that unusual situation, non-custodial, because the custodial parent would usually be the one with the benefits, and this is claiming that the non-custodial parent attaches the form or statement to his or her return. If the divorce decree or separation agreement went into effect after 1984 and before 2009, the non-custodial parent may be able to attach certain pages from the decree or agreement instead of Form 8332. B, a pre-1985 decree of divorce or separate and maintenance or written separation agreement that applies to 2018 provides that the non-custodial parent can claim the child as a dependent, and the non-custodial parent provides at least $600 for support of the child during 2018. So that's going to be kind of a special rule within the divorce process. So you want to look into that if you're going through, if there's kind of special issues within the divorce settlement, and make sure you have those laid out. Back to the text. For details, you want to see Publication 501. If a child is treated as a qualifying child of a non-custodial parent, so again, qualifying child of a non-custodial parent, under this special rule, the child of the divorced or separated parents or parents who lived apart, only the non-custodial parent can claim the child tax credit or the credit for other dependents for the child. However, only the custodial parent, if eligible, or another eligible taxpayer can claim the child as a qualifying child for the earned income credit. So note that there's kind of the separation of separate, two separate things there. So just be careful with this special rule. For details and examples, see applying the tiebreaker rules to divorce and separation agreements or parents who live apart. We want to check out Publication 501. So if that applies to you, you can start by looking at 501 and get advice from there. In this presentation, we'll take a look at the Earned Income Credit Tax Tables. This information comes from Publication 596. The tax tables are what are going to determine how much the earned credit basically is based on the income level. They can be kind of daunting to look at, but they're the only way you could really get an idea, given the complexity of the earned income credit, of what the tax will actually be, what the credit will actually be. So let's get an idea of these tables, and we'll get an idea of the factors that are involved in them, and then you'll get an idea of what types of things might increase or decrease in earned income credit given a certain condition. So these are the 2018 earned income tax tables. Let's go through our columns. First column, if the amount you are looking up from the worksheet is, so the worksheet's going to have basically your modified income for the earned income credit calculation. If you're getting specific and having the specific calculation, you want to have that number. If you want to get an idea of what the range is for the earned income credit, then we're thinking of our AGI type number, our gross income type of number within these ranges, which is going to have a low limit and a high limit. And we, of course, are going to find our number, our income, and find the relevant range. And then we're going to go to this area in our table. And you can note this is a bit confusing because now it has two separate columns. One, let's start with this one, is married filing jointly. So that's going to be one filing status, and then all other filing statuses except the filing status of married filing separate, which is not on the table at all because it's not included, are over here, which is typically would be head of household and single and qualifying widow or widower, these being the common two. So we've got the married status and then basically everything else except for married filing separate, which isn't here at all because it's not included. And then we've got the children. So we've got the married filing jointly, and the number of children you have is 1, 2, 3, 0, 1, 2, and 3. So, and obviously the ranges then will differ, or the amount of the credit will differ based on the children. So obviously more children would typically mean that we would have more income. So as we scroll down the table, you'll see that the ranges will be here. So the at and the to. So if we had $1 of income, then we typically qualify for the earned income credit, but of course it's going to be very low no matter what column we're in. If we're single, $2, $9, $10. If we're within 50 and 100, notice it's going up now. So this is our earned income. This is basically our variant of our earned income. And if our income is between 100 and 150, somewhere in here, then of course our credit is going up. As we can see, this is the single status. And if we go to the married status, you can see the numbers for the married status between 150 and 200. Obviously it's going up, and we can see this trend as we go down here. If we pick a number down here, if we have earned income between 800 and 850, notice our earned income credit, whether we have 0 children, 1 child, 2, or 3, is increasing as our income is going up. And note again, that's kind of funny because you'll know that the earned income is given basically to people that might have more need for the earned income, and so you would think it would go up as income goes down, as there's a decrease in income. So it's a little bit funny that this is going to happen. So what you're looking for, obviously, to maximize the credit, is you're thinking, well, if I have 0 child, 1 child, 2, or 3, when does the credit max out and then start going down again? Because if the income is very high, if I have a lot of income over the caps that we've talked about, then no earned income credit is going to be received at all. So if you have any kind of ability to think about how much earned income you have during the year, then your question, of course, would be, well, at one point in time would the earned income cap out and then go back down basically after that point in time? And that could help you with basically some tax planning type of decisions in terms of qualified children, who claims the qualified children, what's the earned income, if you have any flexibility with certain types of income that you can claim, like maybe possibly combat pay or something like that, then what point in time. So next time we'll follow some of these tables and we'll look at some of those peaks, and we'll just look at some examples. And that's the only way to really kind of do this, is to say, well, what if I was single and I had 1 child? What would the income do if we go up? When would it max out, and when would it go back down, basically? And what if I had 2 children? What if 3 and we were single? Well, what if we were married with 1, 2, and 3? What type of income levels would get the higher credit, and when would the credit basically go down as earnings increase? So that's questions. We'll take a look at some examples of this and just observe the table, and then put this into tax software and just see what the tax software says and see if it lines up with the table. In this presentation, we will use tax software to take a look at the earned income credit for head of household status with 1 child. And we know that as we look at the tax table, that the earned income credit is an interesting type of credit because it actually goes up as there's an increase in income. At some point it tops out and then it goes down as income increases. What we want to get a feel for is, well, okay, what if we are different filing statuses? What if we have a different number of children? What's going to be the shape of this curve? How much does it increase by as the income goes up? What does that look like? How does it top off? Does it top off for a long period of time? When does it start to taper back out? And when does it actually go down? What's the rate of decrease? And when does it go down basically to zero with different statuses? Now, the things that are factors, of course, are the filing status, either married or head of household typically would be the two major filing statuses, and the number of children, 0, 1, 2, or 3. So here we're going to test head of household with one child, and we're going to compare that to the tables. If we consider the tables then in publication 596, they look like this. We're considering these items here, the head of household section, head of household, and we're considering this column, so between one child. And so you could say, okay, here's the income levels increase. You can see what happens to this column. So as these income levels go up from very low income to increasing the income, now we're at 2,800. The credit, according to the table, for the one child is 944. So if we continue to the other side, we're over here, we're saying, all right, now we're still on this column now, and now we're at about 3,000 of income, $1,000. So let's check that one. If we're here, we're going to say around 3,000 for a head of household. That's going to be $1,000. Let's check that in the software. Within the software, we have our single individual. We're going to have head of household rather than the single status because we have the child here, which typically would qualify for the filing status. We're going to say that the income is $2,999. We're going to say that that's earned income. No other information in there in terms of adjustments. Therefore, that's the AGI as well. And no tax, of course, because it would have to be over $18,000 in order to owe any taxes because that's the standard deduction. So no tax is owed, and we're currently seeing the software is calculating the earned income credit at 1,012, which is, of course, in accordance with our table. So 1,012, we have the one child and the head of household filing status. Now, Gordon, if you went back and you said, okay, what would happen if this was $1? Then again, you still qualify, but that doesn't really tell you much. It's $9, right? That doesn't really. What we need to know is kind of the shape of the curve in terms of, when does it go up and when does it go back down, and that's going to be based on, of course, the filing status and the number of children, which we're just testing one child, and the income level. So let's go back to our tables. We're just observing this column to get a shape, but just get a feel of the shape of the curve. We could actually graph this, of course, too, which would be nice, but we're not going to do that here, maybe later. So we can see the income is going up, and here's what's happening to the credit. So the credit's increasing as the income level goes up because they're trying to incentivize work, earned income going up. So you can't have zero earned income. So if you're at 5,000, then it's up to 1,896. If we keep on going, we're now over here. We're at the 5,600. So we're in this column. So let's take a look at it. If we're at, let's say, between this column, so 6,000, we're going to take a look and test that out. So if we say we highlight that, we would think the credit would be right there. Let's say $6,025. So to see what that means on the tax return, we'd have here's the head of household filing status, one dependent here, and we've got the $6,025. We're just going to say it's W-2 income, earned income, no taxes paid, still at zero on the taxes, and that's calculating the earned income credit at 2,049. So 2,049, which is this amount for the one child here. So we could see that item again. If we keep on rolling down here, we're going to say, all right, if we keep on going up, you can see what's happening. The credit's still going up. We're at 8,000. The credit's still going up. If we go to the other side, we're at 9,000. We can see the credit's still increasing here. His credit's still increasing at 9,000. It seems to kind of level off here about this point. So if you're at 10,000 right there, we're going to say 10,175, let's say 10,175. If we were to say that income was 10,175, what would happen then? Well, that's going to be our income level, W-2 income. Still no liability because we're not over the 18. They've got to get over 18,000 before we owe any taxes. And then we're at 3,461 of the earned income credit. That's basically money back with no taxes paid. So $3,461. And that's not including the child tax credit. So notice if you keep on going down, that's basically leveling off here at that amount. $3,461 is leveled off at $12,000. $3,461 is still leveled off with the gross income or the net income, the AGI, $12,000. So notice it's leveled off there for quite some time at that amount. And then if we go all the way up to the 18, it's still leveling off at this amount with a 1. And so at this point, 18,000, we basically have actually income, a tax that could be owed at this point. So let's say we take 18,025 and say, all right, well, what happens if I have 18,025 on a tax return? 18,025, just for test this out. Now you'll note that 1825, that'd be our W-2 income, and the 18,000 is the exemption for a head of household. So we'd only have taxable income of $4, right, or of $25. So the tax would be $4. So we would owe $4 of taxes, and the $4 would probably be wiped out if there's a child tax credit to 0, and then we'd still have the earned income tax credit of that $3,461 is still there. So it looks something like that. Notice that we may actually be owing tax, however, now that we're past the 18,000, and this credit would then be in that situation. So it's still at the 3,461, so it's leveled off. You can imagine the curve kind of topping out, leveling off at this amount as income increases. In other words, the credit remains the same. And then as we get to the income that's getting around the 19, so if we get to the 19,000, let's say 1925, we can see that it starts to go back down again. So if we take this item here, we're going to say, all right, let's say 1925. See what happens if we say the income goes up to 19,025. We're going to see the curve should start to go back down. So now it's going to be decreasing. There's our income. That means that 18,000 is the standard deduction, so we have taxable income of 1,025, and the tax on it's being calculated at 104, which would be wiped out if we had the child tax credit. And now this one is going back down, 3,403 to the earned income. So now we're over the hump, right? 3,403, and now it's going back down. So now we could see how steadily it goes back down. If you're making over the 19,000 or so, it starts to steadily decline. You could see as the income goes up, it starts to steadily decline. If we get to the 20,000, if we're earning the 20,000 up here, it's at 3,002, and then it starts to steadily decline. If we're at around 21,000, let's say right here, it's getting around 2,000. Let's go a little bit further. If we go back up here, now it's into the 2,000 range, 21,625, let's say. So let's see what would happen there if we had our tax return. Said, all right, what if the income was 21,625? Now we would have the taxable income 21,675 minus the 18,000, which would be the standard, bringing the income. So now we have taxable income 3,625 because our income is going up. The tax is still only $363, however, and it would be wiped out by the child tax credit if we had that, but we're focusing down here, and you can see the earned income credit now is decreasing. It's at $2,987. But again, obviously, now we have an issue if we actually have tax, right? So as the credit goes down, we have some tax that are going to be involved as well. So you can see the interplay between these credits here. So then we've got 2,978 or 2,987. As the income increases, we're still in the 2,000s all the way up till we get to the 24,750. We're at 2,004. And then if we keep on going, we're going to say that if we keep on increasing, it's starting to go down, and it goes around under the 2,000 once we get to the 27. So once we get to 27,825, let's say, so 27,825, now we're under the 2,000. So 27,825. So let's go back over and say, all right, what if we're at 27,825? And we'll see what happens here. So now that's significantly over our standard deduction. We have 9,825 of taxable income, which gives us a tax of 983, which should be wiped out by a child tax credit if we still have that. And then, of course, our earned income credit is now going down substantially. So 1,970 or 997, 1,997 as in our table. And then you can see how it basically decreases here with the one child. So we have the decrease here, and it goes significantly down. We're around 1,500 when it gets to 30,000. So if we have 30,006 or so, 1,500. And then as we keep on reducing with the one child, we're around 1,000 on the child tax credit when we get to about 33,006. So let's test this item. See what that would look like if we were at 33,625. So let's say we had income 33,625. See what that looks like. We'd say, all right, now there's income 33,625, 18,000 standard deduction brings the tax to 15,625. And so tax is now going up to 1,603. So we actually have a tax bill of 1,603. If we had a child tax credit, it would wipe it out most likely. And then we'd say, but now the earned income credit's going down. It's only about 1,000 now. So 1,070. So 1,070. Notice the tax is going up, obviously, as the income goes up. And so then it's well under at the 34,000 of income. And then if we go back up, now it's being significantly under, 1,000 now, and we're at income of 35,700. So if we get down to a $500 level, it would be at income of like a 37,100. You're at the 500. And so note what that would look like if you're taking a look at the tax return, because now of course we would owe taxes. So 37,125. So if we went to the tax return, said we had 37,125, we'd say, okay, so there's the income tax, the standard deduction 18,000, 19,125 then is going to be the taxable income. 2,023 is now the tax, and that might not be wiped out by the child tax credit. So we still have tax left over, and of course now our earned income credit is only 510. So you can see obviously this is going down significantly. And of course the tax is going up as the income goes up. And so then we'll see it significantly going down here as well. And then once we hit that level on the cap, it goes away. So when you look at the code and it says, hey, your income level, you can still get the earned income credit all the way up till this income level. Well, yeah, but it's pretty small by that. What you really need to know is the shape of the curve. What's the curve look like as you go through? That's the income increases. In this presentation, we will use tax software to take a look at the earned income credit. We're looking at a head of household individual with 2 children to see what the shape of the curve would basically look like. So we know that as income goes up, as earned income goes up, the earned income credit actually increases until it caps out somewhere, and then it starts going down. The factors involved are the filing status. In this case, we're saying head of household, number of children. In this case, we're going to say 2. And we'll kind of examine what the shape of that curve looks like. Here are the tables from publication 596. Now we're considering this column. So we're head of household and we have 2. We're saying 2 children. And again, if you have 0 income, you don't get any credit. But if you got 1 income, we're just thinking like W-2 income here, we'll say, then it could be $10, right? And then it's going to increase from there. And you can see the difference between this item and if you had 1 child, it's obviously more over time with 2 children than the 1 child. And then as income increases, it's actually going up. And you could compare the rate of the increase here with the rate of the increase for 1 child versus 2 child in the head of household. So you can see it's going up higher. And we have higher amount with the 2 children. So if we're up to here, if we're around 2,800, let's say 2,825, or let's say 2,775, we are over here. Let's consider that in tax software. If we had the 2,775 of income, let's say, we should be at 1,110 of the credit. So if we go back over to the tax software, we're going to say, all right, now we have the individual but head of household filing status because we have the 2 dependents. So we got the 2 dependents here. And we're going to say that the income was 2,775, which of course means that we don't have any tax because the standard deduction is 18 and no tax is paid. And we can see now that we have the 1,110 of the earned income credit coming back. So notice this amount's going up even though the tax is not going up at all until we get over the 18,000. So if we go back to our tables, then we're going to say, all right, so there's that. If we keep on increasing our wages then, and we're considering this column, so we're increasing our wages, we're considering this column over here, we'll say, all right, when does it get to 2,000? If we say the credit's now around 2,000, if we have 5,000 of income, so we'll say we're in this column, we're going to say, all right, what if the income was 5,025? Well, all right, well, 5,025, we'll say 5,025. What's that look like on the tax return? Again, we have our two dependents, head of household status, and no tax paid because it's that 5,025 is under the standard deduction. And now we're at 2010 for the earned income credit. We're not considering the child tax credit here, but that, of course, is another consideration. 2010, that's what we have. Okay, so when does it get up to, I don't know, 2,500? So if we're saying we're going to say it's up at 2,500 around here. So 6,000, if we're at 6,300 about, it's at the 2,500. Again, we still wouldn't be owing any tax because we'd have to be over 18 to owe any tax. The income had to be over 18. So if you keep on going down, we're saying, all right, it's at 3,500. So if we're down here at the 8,000, so let's say 8,775, let's say. We'll say, all right, what if we're at 8,775? 8,775. We're going to say, what's the income look like there? So still no tax being paid. And then the credit now is 3,510 with no tax liability. So it's fairly significant there. So we've got 3,510 on the tax credit, the tax credit. So if we keep going up, we're saying, all right, so there's we're at this two children here, so it's still going up, and it gets around 4,000. So if we earned 10,000, let's say 10,025. So let's say, okay, what would it look like if we had income of 10,025? 10,025, 10,025. Then we're going to say, all right, there's our income. Still, we're not paying any tax because the standard deduction is greater than that. And now we have an earned income credit of 4,010. So there's the earned income credit 4,010 there. So if we keep rolling down, it's continuing to increase. So we're still going up at 11. So at 12,000, we're at 4,790. So if we keep going down, we're in this area, we're at 12,000 around on the income. We're at 5,000. So if we had this item, so we're saying, all right, what if we made 12,575? So all right, let's say 12,575. What happens here? Well, we still don't owe any income. We don't owe any tax because it's less than the standard deduction. And now we've got 5,030 at the earned income credit. 5,030. So 5,030. So we're going to say, all right, if we keep going down, say, when does it get to 6,000? Just out of curiosity here, we're going to say, out of the two dependents, does it ever reach 6,000 with the two? It's capping out at 5,716. So notice we have 5,716. We can imagine the curve kind of flattening out there. 5,716 all the way up till we get 18,650. Now we're actually paying tax up here, or we have more income than the standard deduction at least. So let's take a look at the 8,625. So if we go, all right, what if we had let's say 18,625 of wages, and just test that out. 18,625, that's greater than the standard deduction. So we may be paying we have taxable income of 625, we'd be paying $64. That would probably be wiped out by a child tax credit if there was one. And now the earned income credit at 5,716 at that point. So now time we go up from here, we have to consider, of course, now we actually have some tax that's being paid and two credits related to the children, child tax credit, earned income credit. So that's the 5,716. So if we keep going down, we're going to say it's 5,007, and then it starts to go back down. So the highest point here looks like 18,750. 18,750. So up to 18,750, it's at that highest peak, and then it goes back down. So 18,800, this is the point where the curve is starting to go back down, and you can see now it's decreasing as income goes up. So if we're at the 19,000 income level, now it's starting to go back down. Let's say if we made around 20,000, so let's say we made 20,025, this is where we would be at. Now, 20,025, we're going to say 20025. Say, what does that look like? Well, now we've got we're over the standard deduction, so 2,000 of actual taxable income, which is taxed at the 10 of 204 tax then, wiped out by the child tax credit if there was one, and still have that 5,429 back as well. So still, again, not paying any taxes, of course, it being wiped out, and the child tax and the earned income credit's pretty high there. So we're going to say, all right, well, if we keep going back down with the 2 children, we say, all right, see if we got the 2 children, and we're at, let's say if we go up to around 25 of income, so we'll say what happens at 25 of income, then it goes down to around that 4. So now if we say 25,025, so let's say 25,025, now we're going to say, all right, so now the income is over that 18 by the 7,025. So here's our income over the standard 7,000. That means 703 of tax, but it probably gets wiped out by the child tax credit. And then the earned income credit's still pretty significant, 4,376. So 4,376. If we go up to, let's say, 30,000 of income. So let's say we go, all right, what if it was at 30,000 of income over here? Now it's going down to the 3,000. So 30,000 is there. So let's say 30,025. So I'll say, what happens if it's 30025? Just out of curiosity. Now at 18,000, taxable income 12,025. Tax is now at 1,203. Still wiped out by the child tax credit, which will go up to $2,000 most likely if there's a qualification. And if there's 2 children, it'd be up to 4,000 there. And so, but we're not talking about that now. So in any case, here's the 3,325. So again, it's pretty significant still here, but going down, of course. And so if we keep going down, we can say, well, what if we're at like 30,500, 35,000, let's say. We could see it's going down fairly significantly and say, okay, so if we're at the 35,000, here it is. So what if we're at 35,025? We'll say, all right, 35,025. So 35,025. We can see then that now we're well over the 18,000 standard. We got taxable income of 17,025 now. Tax 1,771. Still probably wiped out by the child tax credit, which again, with 2 children, would probably be up to 4,000, right? And then we have the 2,270, the earned income credit now going down fairly dramatically. So we have here at the 35, and then if we're up to the 40,000, so if we go all the way up to 40,000 of income, so here it is at the 40,000. So we've got that item. And we'll say 40,025. Let's say we said, all right, what if it was 40,025? And see what that looks like. We're going to say now it's at 40. And we're 20. And so 18,000 is the standard. So 22,025. Tax is now up to 2,375. Again, with 2 children, if they were both qualified, the child tax credit might wipe it out there and still have the earned income credit of 1,217. Okay, so if we keep going down, we're going to say, all right, it keeps going here at 40,000. If we at 40,000 of income, we're looking at this column, so notice it's gone now for the 1, but for 2 children, it's still there, right? So we still have this credit for the 2 children. If we go up to, even up to 45,000, you can still see it's still barely holding on at the 45,000. So we're going to say, all right, what if we made 45,025 and said now we're at 18,000 is the standard, so 27,025 over the standard. $2,971 is going to be the tax, still would be wiped out if there are 2 qualified children for a qualified child tax credit, but that's not where we're concentrating. And we're down to the 164 for the earned income credits. The earned income credit is the 164, and then it finally gets wiped out down here. In this presentation, we will use tax software to take a look at the earned income tax credit levels as income increases for a head of household individual with 3 children. So we know that the earned income tax level, the amount of the credit, will increase as income goes up, as earned income goes up to a certain point, and then it will decrease. It'll be dependent on filing status and the number of children. This time we're looking at head of household filing status with 3 children to consider what the shape of the curve will look like as income goes up, what happens to the earned income credit, when does it cap out, and then what's the decrease rate as it declines as income goes up over that level. Here are our tax tables from publication 596. So now we are considering the income levels are on the left. We're now considering the head of household, this side, rather than married, with 3 children. So we got the 3 children, and that's going to be basically maxing out the credit. So we're on this side as income levels increase. If we have no income, then of course the credit is 0, and we can see it increasing with the 3 children. This is the column we're concentrating on. As we go down, you can see the comparison as income levels go up, the comparison between the 0, 1, and 2, and 3 children. So we're concentrated on the outer column here, and you can see it increasing. So it's going to increase substantially faster for the 3 children than, of course, the 0 children over here. And you can see that it's up to over the 500, 600, over 600 at this level. So if we were at this level of income, so we'll say, all right, well, what if we had 1,350, let's say 55, 1,355. So we're going to have our individual, we have Adam Smith, we're going to say head of household filing status. We got 3 dependents now. We're going to say that they're all qualified children. We're not concentrated on the child tax credit, but we're just going to keep that there. That's going to be our income. We'll just say it's W-2 income of 1,355. No tax would be paid until we get over income of the 18,000 because head of household status, that's going to be the filing status. So nothing would be paid there, and the credit is currently at 619. So 619 at that relatively low level. It increases, of course, substantially as the earned income goes up. So we were at this 619 at between this range of income. So now we're going to say, okay, what if income increases? You can see that this range is increasing substantially from 600 up to over 1,000 if we have the 2,000, right? So if income went up over 2,200, we'll say, let's say it was 2,225. So we'll say, what if it was 2,025? Ooh, 2025. We're going to see what happens there. It's still substantially less than, of course, the standard deduction. No tax would be paid. And now we're at 911. We're getting close to 1,000 on the tax credit there. So that would be up here. And it would be 225 here. So if we keep on increasing, we're going to say, all right, well, what if we increase the income? We're concentrating on this column. It would get up to around 2,000. So around 2,000, if we had income of 4,500, again, no tax would be paid until we get over 18,000. So we're at 2,000 of a credit and no basically tax typically. So if we go all the way up to 6,000, we're at 2,000. If we get up to 6,400, let's say, or 6,375, we're getting close to 3,000 credits. So 6,375, let's say 6,375. What does that do to our tax software? So now that's be our income. It's still well under the 18,000, so there's no tax. And if we scroll down, we're going to say now that the earned income credit's going up substantially, now it's at 2,869. So now notice as income goes up, taxes aren't going up. We don't owe any more tax until it gets over 18,000. But of course the credit is going up and the amount of refund is going up then. So there it is at that amount. So now if we keep on, when does it go up to 3,000? It jumps to 3,000. Well, there it is, 3,000 here. If we keep on increasing, we're at 3,500 around, if you get above 7,850 of income. So if we're around this item, 7,825, you're over the 3,500 amount for with the 3 children. So 7,825, what would that look like? If we say 7,825, we're going to say, all right, then again, you still don't pay any tax because it's below the 18, and now the credit here is 3,525 for the 3 with the 3 dependents. So 3,525, actually 3,521. So if we keep on increasing, we're at around the 3,000, and it's still at the 3,000. So if we get up to, it's up to 4,000. If we get up to earned income of 8,925, let's say 8,925. If we were to put that into our software, 8,925. So what does that do? Well, we're going to say, all right, now that's our income. It's still below the 18. So now that the credit's at 4,016, still, again, no tax being owed because we're below the standard deduction on our income. So that's going to be that. So if we keep moving down, we're at 4,500, so around 10,000. So if we had 10,025, we're at 4,500. So let's plug that into our software. If we said, all right, well, what if we were at income 10,025, 10,000, then we're still under the 18, well under the 18. So we don't have any tax that we owe, no liability, and now the earned income credit's going up substantially to 4,511. So it's going up a lot. So then we're going to increase it here. So if we get up to 5,000, it's at 5,000, and if the income is still around 11,000, it's around 5,000 of a credit. Again, no tax here until the income gets up to 18. So if we keep going down, we're going to say, all right, it's at 5,500. Around 12,250. So 12,250, the credit's at 5,500. Let's just take a look at that. 12,000, we'll say the income is 12,225. So let's say, all right, 12,225. If we go back over and say, there it is, still below the 18,000. So 0 there, and now the credit's at 5,501. So 5,501, again, no tax liability, of course. So 5,501 at the 12,000 level. If we keep on increasing, we're going to say, okay, when does it get to 6,000? If we're at 13,350, it's above 6,000. Again, no tax would be paid here because it's not over 18. And so if we keep on increasing, we're going to say, all right, it can go all the way up. We're at almost 6,500 with a 15,000 of income. So we're going to say, and then it kind of flattens out. So you can see it flattening out here. It's at 6,431. If we're at 15,000, actually all the way to 14,400, you're at that flat. It starts to flatten out at that 6,431 from income of 14,400, and it's still at, let's do that again. We got 6,431. And then if we come back over here, 6,431 all the way down, it's flat. You see the curve, you can imagine it being flattened out. We're at 18,400 of income. It's still flat there. And then 6,431. And then it starts to go back down. So if we had income as high as this level, we're going to say 18,625. Let's check that out. 18,625. See what that looks like. Now that's over, of course, our standard deduction, but only by 625. So that would result in $64 of tax. Probably would be wiped out by a child tax credit with 3 children, and then the earned income credit would be 6,431 still. So that would be that, and that would be the kind of the upper level to get to that 6,431 with the 3. So right, and then it starts to go back down. So you can see once you get to 20,000, then the credit's going back down. It's going back down. It's under the 6,000. If if we get back up to income of 20,800 and above, now the credit is below that 6,000. So 20,825, let's say. Let's say we had 20,825 and see what that does. So now we're over the 18,000. And so we have 2,825 of taxable income, tax of 284, wiped out by the child tax credit most likely, and now the child tax credit's going back down, or the earned income credit's going back down. It's still significant, 5,975, right? And so now the income is going up, and we can see this credit's going down, so we can see the shape of it going down as the income goes up. So we got the income, if we're at 25,000 of income, see what happens at 25,000 of income. The credit's down to around 5,000, right? If we go to 30,000 of income, let's just go to 30,000 of income. Here's the 30,000 and the credit's down to 4,000. So let's just check this one out. Let's say it was 30,025 of income. So 30,025. So we'll say 30025. And now we're well over the 18,000, right? So there's the 30,025 W-2 income. There's the 18. 12,025 is taxable. 1,102 tax. We have a tax probably would be wiped out by the child tax credit with 3 dependents, because that could be up to like 6,000. And then we're going to say, and then now the earned income credit is at that 4,037. It's starting to decrease, of course. Still money back with no liability. So then we're going to say, all right, so there it is. It's going down. If we're at 30,500, you'll say, all right, what happens at 35,000? If we go to 35,000, would be here. So it's still at 2,900. So if we're at 35,000, see this item. Say, all right, what if it was at 35,025? So I'll say, all right, let's say 35,025. Now we're significantly over the 18,000. So we have 17,025 of taxable income, 1,771 of the tax, wiped out most likely by the child tax credit. And now the earned income credit is 2,984. So 2,984, 2,984. If we go up to the 40,000, see what it does at 40. So we'll say, all right, 40,000. Here's the 40,000. It's down to a little under the 2,000 of a credit now. So let's say it was 40,025. So if we go back over and say, all right, what if it was 40025? See what that does. We'll say that's going to be over the 18,000 by 2225. So now we have a tax of 2,374 of 71, but it's wiped out once again by the child tax credit most likely to 0. And then we still have the earned income credit of 1,931 on top of that. And again, I'm not getting into the child tax credit, which is another significant factor. And so if we increase, we're going to say, all right, what if we're at 45? So if it increases up to 45,000, here's the 45,000. Now it's at almost 1,000 still. So if we had 45,000 here, so let's say 45,025. So let's say, all right, what if it was 45,025? See what that does. So now we're at the 45,025, 18,000 is still the standard, 27,025 over. So the tax is 2,971, still probably wiped out by the child tax credit. And then we've got the 878 of the earned income credit going down, obviously substantially now as the income is increasing. So if we go up to the 50,000, so even up to, we go close to 50. So it's going to be completely gone here at 49,150. So 49,150, it's down significantly at that point. In this presentation, we will use tax software to run scenarios related to the earned income credit and a situation of being married versus divorced. In other words, either a situation where we have a married couple that is thinking about getting divorced, what would be the tax consequence of one tax return that would then be two tax returns in some way, or two individuals that are going to be separated that decide to get married. In that situation, we have two tax returns being in essence converted into one tax return. We'll be thinking about situations where there's an even split of income first. Even split meaning we're going to think about the married couple having even income being earned by the two people within the marriage. So if they were to divorce, they would have even split of the income. Or if we have two individuals that have an even income amount and they were to get married, then they would be twice each individual income. Here's the first scenario we will look at. We're going to say the married couple will have $45,000 between two of them. So if we have one tax return and then we were to split it from like a divorce type of situation scenario, we would have the $45,000 and then split evenly of the $22,000 and $22,500 between the husband and wife. It could just say spouse one, spouse two. We're just looking scenarios between these two. And that's going to be our first split. You can think of it also if you're in, a husband and wife or spouse one, spouse two, two individuals thinking about getting married who had the same amount of wages, then what would be the scenario from go to here to getting married to have $45,000 on one return. Then we'll also have one child involved. So one child might maximize a child tax credit of the $2,000. We'll think about this situation first with just one child. Here is our test 1040 where we have the married filing joint individuals, the Smiths here. We've got the mock information and we have the one child. So the one child is a qualifying child for the child tax credit as well. We're concentrating here on the earned income credit, but obviously when we look at these scenarios, the two are going to have some interplay between them when we think about these scenarios. So we got the $45,000 of wages. That's between both the husband and wife. It doesn't matter who earned it now because they're on the one return in essence for the most part. So we're going to say, all right, the $45,000, that's going to be the total income. That'll be the adjusted gross income as well. We're going to say that there's $24,000 of the standard deduction. We're just going to take the standard deduction, not itemizing here. $24,000 for married filing joint, as can be seen over on this side in the instructions. Therefore, we've got $21,000, the 45 minus the 24 being the 21, that is taxable, and so that's our taxable income. The tax calculated by the system is currently at $2,142, so this would be the tax before any of these credits, the child tax and the earned income. Now, the child tax credit's not what we're concentrating on here, but we can think of it we have to kind of consider it to a degree. So the child tax credit's going to be here. Typically, it's up to $2,000 per child. So we'll say, all right, $2,000 one child, $2,000 credit brings the amount down to $142. So only $142 would then be owed. And then we're going to say, now there's an earned income credit. This is what we are calculating on. They just barely qualify for it right here. So we're at $157 earned income credit. So there we have it. And that's going to bring the amount refunded to $15. So $15 refund. Nothing was paid, so we didn't owe anything, and we're actually going to get a refund, even though we're getting money back. So no taxes paid at all. We're getting some money back due to these credits, basically taking us down below a tax liability of $0, getting a refund of $15 in this case. So if we fill out our table, we're going to say, all right, $45,000. They get a credit. For the child tax credit, $2,000. Earned income credit's pretty low. It's only $157. This is where we are concentrating. And they get a refund, which I'm going to represent with a negative of $2,000. So that's good. They actually get money back in this case. Okay, what about the scenario where we have an even split between these two individuals, husband and wife? We could, again, just call them spouse one and spouse two. I'm not, we're just testing this out. So if we say then, what if this spouse gets the $2,000 of the child tax credit, or however much can be applied given any restrictions, and then this one would then get nothing if we then had a separated agreement. So we had married, now we're going to separate, and we have the one child has to go to one or the other, typically general rules, right? So even split of income, we'll just pick one and go there. So let's say that happens. Let's see what that'll look like. We'll first look at the spouse that is going to have the child. So we'll say the child tax credit goes to one of the spouses. I'm just using the same name. Clearly, it's going to be the same name all the time. So spouse one, the one that has the child here, is going to be a head of household. So probably being qualifying for a head of household due to the fact that they have the child. So that's one of the factors that's going to be influential in that process. So we've got that, and we got the child tax credit, which we're not focusing on here, but that is something that is part of the process. We're concentrating on the earned income. So now there's only income of 22.5 because we split it in half now with an even split. 2 tax returns. This is one of the 2. And then the 18,000 is the amount of the standard deduction because they're not single, which would only be 12,000, half of the 24 we saw at married, but 18 because of head of household, in part probably because of the child. And that leaves the taxable income of 4,500. Taxable income of 4,500, tax being calculated by the system, 453. And then the child tax credit is going to probably wipe that out. We're not focusing on the child tax credit, but probably going to be wiped out by the child tax credit. And then that leaves us then with the earned income credit. Now, let's think about the child tax credit. It's a little funny. So the child tax credit is actually the sum of these two, or the child tax credit and the additional child tax credit. You know, we'll think of them. This is going to bring it down to 0, and this amount is going to be what's going to bring it past 0. So it's going to be somewhat limited then. So the child tax credit and the additional child tax credit is the 153 plus the 1,400, or 1,853. So we're actually limiting. It's limited. It could go up to 2,000, but it's being capped at that 1,000. So that's what all we want to know basically for now. It's basically being capped there. And then the earned income credit is this 2,844. So that's substantially higher than it was before. And then we have this refund of 4,244, which is, you know, this is a big refund. Again, not paying any taxes here. This is basically all, you know, money coming back with no tax liability. This is all no liability and a refund. If we see this in our worksheet, then we're going to say, all right, now this is half of our one spouse. Didn't get the full credit even though they have the child here. And then we have the earned income credit substantially higher now, of course, because of the law. And then the tax is actually a refund, which is better. This is a huge refund. So this isn't really a tax. It's money back. It's not even money back. It's money that we never paid in, right? So it's going to be a benefit. So now let's think, well, the other situation is not as good, of course, because they don't have the child. So what would it look like for the other spouse? The other spouse would have to probably file single rather than the head of household status because the child isn't there. So if it was only the one child, then possibly it would only have to file single. Again, same name. So we're just picking one spouse, other spouse. And then if we go down, we're going to say, okay, the 22,500 is still the income because we split that evenly, saying 2 people work, W-2 income's the same for both. And now the exemption, the standard deduction is only 12,000. Why? Because they're single rather than head of household. If they don't have a qualifying child, most likely, if they don't have it, probably that's the case. So in any case, so we're going to say then the tax is owed at 10,500. So the tax is going to be 1,073. 1,073, no earned income credit because they're over the amount to get the earned income credit. So they actually have taxes that of the 1,073. Now, we're not going to talk about a penalty down here. So the 1,073 is going to be the tax there. So if we were to compare that, then of course you can compare the 2 spouses with the individual being split out. And then you can sum those up and compare the total. Obviously, the total wages is the same. The amount of the credit is actually lower for the child tax credit because there was a limited there. The amount of the credit is much higher for the earned income credit under the 2 separate returns rather than the single return, which is kind of interesting to note. And then the actual tax is a lot better because this is a refund. This is the amount owed. So actually, it's a net refund of 3,171 between the 2. Again, it's not evenly dispersed, but between the 2, actually, in this scenario, it looks like the separate returns, according to what we've just entered into the software, looks a lot better. And this is one of those scenarios that's a little weird. It's a little concerning, actually, because it would mean that the separate returns, it seems like it gives an incentive to have not be married as opposed to being married under certain conditions, which seems kind of unusual. But in any case, that's what we're looking at between the 2. You can see the 2 differences between the 2 spouses with that one setup, and then the difference between a single return and 2 single returns and the married return. Again, just with the scenario, just with the data that we entered into the tax software here. So that's just a quick scenario. Let's take a look at another one. In this scenario, we will start off with the same information in that we have the same income that will then be split between the two separate returns and the married return. So we have the $45,000 when married and the $22,500 when separated. We're going to say that there's going to be 2 children, which is a potential of a $4,000 child tax credit, and then we'll go from there. We'll start off with the married side again, and then have the combined return, which will then split up. So we have this information, married filing joint. We've got the 2 dependents now, and they both are qualified children for the tax credit. So that's going to be our starting point. We're going to say that we have the $45,000 of income between the 2 of them on one tax return because it's married filing joint. And we have the $24,000 is the standard deduction given here for a married filing joint tax return. Therefore, the taxable income is $21,000. The tax is the $2,142. Which would probably be wiped out by the child tax credit if both children were qualifying, because it could be a max of $4,000. And again, we got this kind of funny interplay, but I'm just going to say the child tax credit and the additional child tax credit are this 2,142 and the 1,858. If you want more information on why that breakout is, take a look at the child tax credit portion of another video. But in any case, that's the $4,000. So that's the $4,000, and then here's our earned income credit of 1,362, and that gives us basically a refund. Again, no tax paid, no liability, not even really a refund, but just money. We get money, right? The government's giving money with no taxes of that 3,220. So here is our summary. If married, $45,000, $4,000 total credit being taken for child tax credit and additional child tax credit, earned income according to what we put in, 1,362 for that credit. We're getting a refund back, 3,220. Now let's split it out between the 2. Let's put 1 child on each return. So each spouse gonna have 1 child. That would be the evenest split that we can have. Let's start there. So here's our test 1040. So again, we're just choosing 1 tax return all the time. So here would be 1 spouse. Of course, both spouses would be exactly the same here under our scenario because we're breaking the income out evenly and having 1 child on both returns. So now we are imagining 2 returns, which are in essence the same. And we have the head of household status for both of them because now there's 2 children. One of the children will be on one return, the other on the other, which could qualify both the spouses to then, if they had 2 separate returns, to still have head of household status, as opposed to if there was only 1 child, where obviously then only 1 return can have that. So that's one change here. Different child tax credit, we're going to say is qualified. $22,500, half the income when married. We're going to say that both the husband and wife spouses then earn the same amount of income. So if we split it out evenly, there it is. We're going to say that the $18,000 is the standard deduction rather than the $12,000 if it was single, which would be half the $24,000 because of that head of household status. And then we've got the taxable income, subtracting those two, $4,500. Tax is only $453 would be the tax, but it's going to be wiped out by the child tax credit most likely. If we think about the full child tax credit, it's the 1400 down here. And this is the additional child tax credit plus the child tax credit, $453. And that gives us the 1853. So we're being limited because remember, it could be up to $2,000 on the child tax credit, but it's limited there, just the way we've input the data into the system. And then we have the earned income credit is $2,844, and that gives us a refund. Again, no tax is owed at this point, which is just no money's going to the IRS. It's not really a refund. It's just money the government's giving us with no taxes of the $4,244. So if we consider that scenario, we'll say, here's the married scenario. There was a refund of $3,220 with the 2 children with the $4,000 amount for the child tax credit, $1,366. Now, if we split those 2 up, notice the child tax credit goes down. We don't get the full credit if we have the 2 returns in a divorce situation or 2 separated getting married and the 2 separate returns, then we don't get the full child tax credit under the way we entered this into the system. However, the earned income credit is substantially larger in this case here, given the way it's been input into the system. And, you know, that could be partially because of the head. And the other thing that's changed here is the head of household status. Because really, when you have the married filing joint, the tax code tends to basically break that out in half to, like, if you're single, things like the standard deduction are broken in half and whatnot. So the filing status being bumped up to head of household kind of throws everything off. So in this scenario, it looks like, the way we've entered the information into the system, that there's a substantial benefit to 2 tax returns versus 1. In other words, if you were one of these 2 spouses thinking about getting married in that situation with the 1 dependent and the 22.5 of income, then, and you got married, just from a tax standpoint, it could lower the amount of money you'd get from right under that situation, which again seems to kind of disincentivize marriage under the certain kind of scenarios, which is kind of funny. But in any case, that's what it's looking like here. These are the 2 refunds between the 2. They're going to be both the same because we split everything up completely evenly. And then here's the total tax or the refund, or the amount of money we would get under the separate condition for the 2 individuals. And this would be the refund for if we had the 1 return. And you can see they're, substantially different. Okay, let's take a look at another example. Let's take the scenario where we will start at the same point here, but now we're gonna have an even distribution. So we have 2 children, and let's take the scenario where the 2 children then are claimed by 1 portion or 1 spouse, and then no children on the other spouse. We have 2 children, and we're gonna say, okay, well now if we have 2 returns, both even income, but the 2 children now on 1 spouse and not the other. And again, we're just picking one at random. We could have spouse 1 and spouse 2 here, so that's what we're doing. Okay, next scenario. So this is going to be our starting point at the married condition. So we got married, 1 return. We have the 2 individuals. We have the 2 dependents, both qualified children. If we're going to say that's the 45,000 of income. 24,000 is the standard deduction because they're married now, so that's twice the single, right? And then we got the 24, and that gives us the 21,000 of taxable income. The tax is $2,142, and that's being wiped out by the child tax credit, bringing it down to 0, so no tax after that. Child tax credit and the additional child tax credit, $2,142 plus $1,858, $4,000, 2 children, $4,000, and so it's $2,000 each typically. And then we got the earned income credit, $1,362. So that's the same scenario we started off with the married filing joint 2 with the 2 children. And here it is in our worksheet. And now we're going to break out that 1 spouse has the 2 children, the other none. So we're picked just 1 tax return now. We've got the head of household status because the 1 spouse is going to have the 2 children. So the 1 spouse has the 2 children. Head of household status probably would follow with that rather than the single status. So that's going to be a huge difference. And then if we go down, we're going to say 22.5 even splits. We're saying one of the spouses earns just half of what the 2 did, 22.5. And then we have the 18,000. Here's one of the big differences, 18,000 head of household standard deduction versus the 12,000, bringing the total tax down to 4,500, or the taxable income. The tax at 453 being wiped out by the child tax credit, most likely. And the total child tax credit and additional child tax credit, 453 plus 2,800, being less than the 4,000, right? Because it's 2 children. The max would be 4,000, so that's being limited here now because of income limitations and no tax liability thing. And then we've got the 4,902 for the federal, the EIC credit, meaning there's a refund of 7,702. Again, no taxes paid, not really a refund. The government giving money basically of 7,702 with no taxes being paid. So if we plug that into our worksheet, we're going to say, all right, that's half for the 1 spouse. The credit's a little bit smaller than the full credit, even though the 2 children are here for the child tax credit. Earned income credit substantially larger, and then we get a pretty substantial refund or money for on the 1 spouse in this scenario, according to what we've input in the system. Let's look at the other spouse now that doesn't have either of the 2 children. So let's see what that would be looking like. So now we have the single status rather than head of household because there's no dependent. So probably would have the single filing status then under that scenario, which is not as good. So then we got the 22,500 of the income split between the 2. We're going to say that the standard deduction is only 12,000 rather than the 18 because of the difference in filing status. That gives us taxable income of 10,500, and therefore the tax is going to be the 1,073. We have no child tax credit to wipe it out, and the earned income credit not there either because it's over the amount for an earned income credit if there's no qualified children. So we're at the tax of 1,073. If we compare that scenario out, then of course the one spouse that has the two children then would have a substantial benefit from the earned income credit and the child tax credit. So that would be the refund, money back. And the other spouse would have no benefit from the child tax credit. The earned income credit would pretty much go away. Head of household status goes away if there's no other thing that would qualify for that. And therefore the earned income credit and no child tax credit. So they would actually owe money, right? Under the same scenario, $22,500, they would be owing money, and the spouse would be getting money back just based on the information we entered into the system here. Also note that it still comes out to this money is going to the taxpayer. This one's going away from the taxpayer. The net between the two is $6,629 going to the net two tax repayers, and under the married situation, it was only $3,220. So again, it still seems if you combine them together, that the total tax is, there's more benefit to having the two returns, although it's not as high as it was if we had the split be one child to each, right? One child to each, you would have the split be here versus here under just basically, again, just the scenario that we put into the system under these scenarios. Now, you might ask, well, what would happen? There's kind of some funny situations between these credits, the way they play out. You could do this all day long, of course, but let's think about another situation. What if there wasn't an even split? Because oftentimes there's not, because one of the spouses are probably taking care of the kids and therefore not working. So what would be the split if there wasn't an even? If we had an uneven, so 45,000 married, and then maybe if there was an uneven split between the two. We'll take a look at some examples related to that next time. In this presentation, we will use tax software to take a look at some scenarios related to the earned income credit related to two individuals getting married or two individuals getting divorced. In other words, two tax returns then being combined to, in essence, one tax return in the case of a marriage, or one tax return that's going to be then broken out between two tax returns in some format in the case of a divorce type situation. And we're going to be looking at situations where the income is not evenly split between the two spouses. So if there's two uneven incomes and individuals come together, what's going to be the effect basically on the earned income credit? We'll consider that question. If we have two married people and there's an uneven income earnings between the two, and then they split up in a divorce type situation and then have two tax returns, what's the effect on basically the earned income or some scenarios with it related to that situation? Our baseline scenario will start off with the married individual that will then break up between the two separations. You could think of it, however, as one of these two individuals, if this is closer to a circumstance that we have two individuals that then get married, right? It would be two tax returns going to one, or one tax return going to two. That's kind of what we're comparing here. We have the two tax returns together, married, 45,000, we're going to say between the two, filed on one return, 1040, in a married situation. If they were separated, then we're going to say that there's an uneven split. And again, we're just choosing a spouse. It could be, spouse one and spouse two, but we're going to say the split is uneven of wages being earned of 40,000 and 5,000 to make up that 45,000. So if we had just one tax return, we would be in this situation. This will be our starting point. We're going to say, all right, and if there's one tax return, we have a married filing joint. We're going to say that we're one dependent, and it's going to be a qualifying child for the child tax credit here. That's going to be our starting point. So we're going to say, all right, the 45,000, it doesn't matter who earned it, really. We're going to say that it's unevenly earned, but it doesn't really matter at this time. We're just going to say it'd be filed as wages under the married filing joint return. So we're going to say then there's the 45,000, the 24,000 is the married filing joint standard deduction we're going to take. So that's the standard deduction. That's 21,000 of taxable income. The tax then at 2,142. So we're going to say 2,142 on the tax. That would be that would go down pretty far by the 2,000 tax credit if it was a qualifying child. So 2,000 per qualifying child typically, and so that would bring it down to a tax of 142, which would then further be wiped out by the earned income credit. Not a very large earned income credit, but enough to take out the taxes pretty much completely and still give money back. So no taxes owed, which is nice, and some money from the government of the $15 here. So we're going to say, all right, $15. Again, not a refund, not taxes that are paid. We didn't pay any taxes. It's not, they might call it a refund here, but it's not really a refund, it's basically just money, no taxes paid. It's not really tax, it's just money. So we had that. Okay, so there's our starting point. 45,000, 2,000 credit. We have the earned income credit, and then we get some little bit money back. No taxes paid, a little bit money back. All right, what if we broke it out between 40,000 and 5,000 here? And what if we say, well, who's going to claim the child then? You would think that the one with the larger amount of income is where you want the child, because it might have more benefits in terms of the higher earnings, because from a normal tax standpoint. So we'll start there, but we'll look at both scenarios and see what the difference is. So we'll start off with the child being here with the one spouse that has a higher income. And again, we just randomly pick, a higher income. It could be spouse 1, spouse 2. So that'll be the scenario here. So for the spouse that has the higher income, and we're just going to choose the same tax return each time. So we'll always be using Adam when we have the single return. It's going to be head of household status versus single. And that's one of the big benefits of most likely that you would have as a result of having the one child on one return versus the other. It might take the status from single to head of household. And then if we scroll down to the calculations, 40,000 of income. So we're saying 40 of the 45 was on the one spouse. So we'll say that's here. And then the standard deduction is 18, which is greater than 12,000 for a single. So this is one of the big benefits of head of household status versus single. The single would be half of the married filing joint, which we had when they were married filing joint up to 24. So that gives us the 22,000 of the taxable income. 2,371 would be the liability before the credits. We have the 2,000 of credit because the qualifying child, we'll say it's qualifying child here, of 2,000, bringing the tax down to 371. And then there's the earned income credit, just barely getting the earned income credit under the scenario because of the income limitations. And that means that there's actually still an amount that is owed. So the tax owed is the 324. So in this case, the two credits, the child tax credit and the earned income credit, didn't wipe out the liability completely. The liability is still there, still some tax owed of the 324. So if we plug that into our worksheet for spouse 1 with the larger income, we applied the 2,000 credit there with the child to this individual, and then the earned income credit is that, and then the tax, there was a refund before, now there's some tax owed for this one. Let's look at what would happen with the other spouse if they didn't have the child tax credit here because the child isn't there. What would be that scenario? So spouse 2, which is also, we're going to name Adam here, is going to be single rather than head of household because don't have the child on the spouse 2. So we're going to scroll down and say there's the 5,000 of income. So it's a relatively low income. Of course, there's not going to be any tax paid under that condition because the 12,000 of the standard deduction is well over that amount, and therefore there's no tax liability. So the question then is, well, is it still possible to get some money based on the earned income credit and the child tax credit? Well, if we go down, of course, there's no child tax credit because that's not on this return. Maybe still qualify. We do qualify here under what we've input, the 384 for the earned income credit. So still getting some money, 384. No tax liability owed, still getting some money, $384 without any tax owed, even though there's no child on the return due to the earned income level being what it is. So if we consider this scenario, we would say, all right, then the one spouse owes a little bit, owes 324, and the second spouse would have a refund of the 384, even though there's no child tax, no child applied there. And that's going to be a total between the two of basically a net refund. So this is the refund to one, this person pays, the difference between the two is still a refund of 60, which is actually still a little bit higher than we saw under the married scenario, which was 15 refund. So let's take a look at the next scenario now, and we'll apply the child out in the opposite to the spouse that has the lower income and see what that will look like. We'll start from the same starting point where we have the married filing joint return. We have the one dependent. If we then say that we have the 45,000 between the two on one tax return, married filing joint, we'd have 24,000 of the standard deduction, which is twice the single deduction because they're married filing joint here. And that's 21,000 of taxable income. 2,142 being calculated as the tax by the system. That's going to go down by the child tax credit, 2,000 per child. We're going to say 2,000 here, qualified child, brings it to 142 tax. And then remember, that's going to be wiped out by the earned income credit. Not a lot of earned income credit, but a bit, taking that down to 15, actually money back. No tax owed then, money back in this scenario. So here's the breakout of that scenario. Now we're going to say that between the two spouses, we're going to apply the child to the lower income, in this case $5,000 versus the $40,000 returned. So in this case, we would say the one return that had the $5,000 of income, we're still just going to, they're all named Adam. So Adam is head of household now rather than single. That's going to be one of the benefits. And then we have the dependent here. So the dependent and the child tax credit for this return. We have the $5,000, a fairly low income level, which of course would mean that there's no tax no matter what, because it would be wiped out by the standard deduction, which in this case is $18,000 rather than the $12,000. But in any case, of course, that would be wiped out to zero. So then the question is could money be received given the credits? So we have the child tax credit at $375, which is severely lower now than the total, which it could be up to $2,000, given the income limitations. And then the earned income credit though is $1,709. So if you combine those together, there's money back of $2,084. No taxes paid, even though the earnings were only the $5,000. So that's fairly significant, $2,084 of the money. So that would look like this. We got the $45,000 married, and we're applying out here now to the child. So that means the credit's going to be limited, and that's one of the problems, of course. But the earned income credit is substantial, and those two kind of interplay like that. Sometimes one could affect. If one goes up, sometimes the others go down. Not necessarily, but they can. And then the tax is actually a refund now, or money from the government, $2,084. The second spouse is going to have the $40,000, and again, Adam again, but this time it's going to be single rather than head of household because there's no child here, no qualifying, no dependents. So most likely single if that were the case. $40,000 of wages, and now the standard deduction is only $12,000 rather than the $18,000 because of the single filing status, bringing the taxable income to $28,000. And then the tax is being calculated at $3,173, and there's no child tax credit, no earned income credit because it's over the limitation. So then tax would be due of $3,173. So under this scenario, you would see that the one with a higher income would be owing money, and then there would be money to the lower income because that's where we applied the child, and then you've got the totals here. The total would be actually owing money between the two of them of $1,089 rather than getting money back, which is worse than the married joint because it was $15 money back. And this is kind of what you would expect because you would think that the child would have more benefit to the higher income a lot of the time. It could change with it depends how much the income is and whatnot, because these earned income credits can do funny things as the income goes up and down. But you would think that the head of household status, and that if that was one of the conditions, there could be scenarios with two children, which we'll look at next time, which maybe both can have a head of household status and whatnot. But between the head of household status, the tax rates, and the child tax credit, then you would think it would go over here. The earned income credit can do some funny things though as this income goes up, because of course up here the earned income credit almost went away because the income's too high to get the earned income credit, but the child tax credit's still substantial, and it's probably not going to go away unless the income was quite high. So in any case, let's take a look at another scenario. This time we're going to keep the $45,000 of total income between the two and the same breakout between the two, but now we're going to have two children, which could maximize a credit for the child tax credit of $4,000. That'll be our starting point. Here is our test 1040 then. We have the married filing joint now, and now we have two dependents. So now we've got two dependents. We're going to say they're both qualifying children for the child tax credit. $45,000 back up to the $45,000 of income for the married filing joint. And we have the standard deduction now at $24,000 for married filing joint, bringing the taxable income to $21,000, tax calculated at $2,142, and then $2,142 is being wiped out by the child tax credit, and the total child tax credit could be $4,000, two children times $2,000, and that's being broken out between these two items, so it's at $2,142 plus the $1,858. That's going to be the child tax credit and the additional child tax credit for the $4,000. And so those are in those two places. And then we've got the earned income credit, $1,362 for a refund in essence of $3,220. So again, no tax paid in, money from the government, $3,220 in this scenario. So here is our starting point. Only difference now, $4,000 of the credit before the 2 children, and that adjusts the earned income credit and the tax. So same income, 2 children, and here's the refund, or money from the government, not paying anything to the government. Okay, so now we're going to break this out and say, okay, what would happen if we broke out this evenly and tried to say 2,000, 2,000 for the child tax credit, applying 1 child to each, even though there's a difference in the income distribution. We might not get the full credit of 2,000, but that's what we're going to do, the same 1 child to each return here. So we'll start off with the one that has the 40,000 in it. So we'll say 40,000 of income, and that's going to be head of household status now because we have the 1 child applied there. So 1 of the 2 children applied to each. We're going to say the 1 child applied here, and therefore it's going to qualify for the child tax credit. So there's the 40,000, 18,000 of the standard deduction, which is better than the single because of the head of household filing status. We then have the 22,000 taxable income, tax at $2,371 according to the calculation of the system, and then it's going to go down by 2,000. That's the child tax credit to $371, and then we have an earned income credit of the 47. It's fairly low here because, of course, the income is fairly high to get the earned income credit. That leaves us with tax due of $324. So even with the 2,000 and the 47 of the credit, still owe money, not getting money back. There's still a slight liability of the $324. So we have spouse 1 at the 40,000, 2,000 credit, 47 the earned income credit, and owing money, not getting money back. Now we'll take the same for the second spouse at the 5,000 of income. Spouse 2 would then get the head of household filing status as well, because we still have the 1 dependent, most likely. And so then we have the 5,000 of income. It's going to be wiped out by the standard deduction, which is the 18,000 rather than the 12 because of the filing status, but it doesn't really matter. It's going to wipe out the income no matter what, brings it down to 0. And then we have the child tax credit down here of the $375, or the additional child tax credit. It's severely limited. It could be up to 2,000. It's $375 because of the earned income limitations and the limitations there. But the earned income credit is $1,709. So there's $2,084 back, even though no tax is paid. So no tax is paid, money back, or money to the taxpayer of $2,084. So under that scenario, you can see that the even split between the children between the 2, you've got a little bit of tax owed here for the higher income individual, and then a credit of $2,084 for the lower income individual. If you add those 2 up, the amount of money that is being received by 1 minus the amount that is owed is a net credit between the 2, $1,760. You can see that the child tax credit's being limited still here because of mainly it's being limited, of course, on the low income side on that return. But the earned income credit is going to be a little bit less as well, or it's a little bit more. The earned income credit's a little bit more given this condition. So that's often the interplay between those two. One goes down, one goes up under certain conditions between those 2 credits. And then we've got the tax. If we add the 2 up, this would be the net refund. So it actually works out better here under the married situation than under the even distribution, just the way we've entered the data in. The refund would be higher under the married during the even distribution. And again, that's partially because we're losing some of the deduction or the benefit of the filing statuses, the 18,000 standard deduction, and some of the benefits with regard to the child tax credit. So what would happen if we put the two children on 1 return? Then what if we put both of them on the higher income? Would that have a net benefit? We're going to start from the same point where we have the married filing joint 2 dependents here, and we have the 45,000 of income. So 45,000 of income, 24,000 being the standard deduction. So that's married filing joint. That gives us the tax of the 2,142, and then 2,142 being wiped out by the child tax credit. And if we add the 2 of them up, 2,142 plus this 1858. That's the 4,000 for the total of the child tax credit and additional two children that are qualified times 2,000. And then we've got the earned income credit at that 1362. That gives us, once again, that 3220 of our starting point. So that's where we're going to start here. We're going to say that our current scenario is here. Now, what if we tried to break out the 45,000, 40,000, and 5,000 between the two spouses, and then we tried to give the two children to one, just to see what that would be, because that would be the child tax credit of 4,000 if we could maximize it out, the 2,000 each for the one return. So in that case, we would say, okay, head of household status would be for the one individual, and now we've got the two dependents on one return with a head of household status, and then the 40,000 of income, 40,000 of the 45 for the one of the individuals, 18,000 of the standard deduction, which is better than 12,000 for single. It brings the taxable income to 22,000, tax being calculated by the system 2,371, and that's going to be wiped out by the child tax credit because now we've applied both of them to the single return, and that should be a maximum of 4,000. So between the two, we've got the 2,371 and the 1,629 of 4,000 between the child tax credit and the additional. And then we've got the earned income credit at 1217, meaning we're going to get money from the IRS, no tax being paid, money from the government of 2,846. So here's that refund. Now, on the other side, we'd have no child tax credit because we're not applying the child there. So let's see what the scenario would be for the $5,000 return. The filing status we're going to say is single because there's not going to be any child here. So we'll say the single filing status. We're going to say 5,000 will be the income. Standard deduction 12,000 rather than the 18,000 for the single status. However, it doesn't really matter because that's going to wipe out the income anyways to bring it down to zero. No child tax credit because there's no child there, but there's still a small amount of the earned income credit, 384, even though there's no qualifying child. So it's reduced, but still there. And that means that there would be no tax paid, obviously, but and you'd still have some money from the government of the 384. So in that scenario, it's going to look something like this. We calculate according to the system that refund for the higher income earner of the 2,846, and then the lower still gets money back of the 384. Again, neither of these paying money in. It's all basically money from the government to the individuals. So the 2,846 and the 384, that's the 3,230, and that's pretty close to the net total on the married filing joint return. So that's pretty close to the total there. So again, if you have the differences between the income allocations, it can have a lot of different effects depending on how high the income is between a married and two separate returns and one return, married versus two separate returns, head of household and or single.